All right. Markets are open. All right, see if we can't get a little rally here off the low.
SLE halted to the upside. EFSA. MUU. IRN. SPCH. KORU. WETO halted down.
Okay. So Oracle gapping down. Starting to find a bid now. Core 1M is back, was back to 850 yesterday at the close. So spasm risk to your open options positions. Again, an issue. Not as bad if we continue to move a bit higher. Top stocks on the NASDAQ 100: Intuit, Thomson Reuters, Roper Industries, Adobe, Autodesk. A lack of chips and semiconductors showing up today. Yesterday was all chips and semiconductors early in the morning. They ran it up and then faded it. The markets. Futures trying to push higher. Off of the low, we're at 77.31 futures. Support today for the S&P 500, 7,700. Resistance 77.20. Let's look at trace. We can see those levels. 0 day. Okay, major level right there at 7,700 identified for the S&P. Okay, Copart was a breakout on Friday. Copart, that continues. Copart continues. I currently have Copart. I took the December 35.40 call spread. All right, so that presently, Copart, if you're interested, still a valid trade. We're just getting started this morning. Those December options, I just want to check the deltas here. Okay, so that is a 41 delta. The 35 strike is a 41 delta. That's as far as I usually will go. I won't go below 40, 30, 35. That's usually if it has high implied volatility. If it's below 40, say 30 or 25, I'll be looking to sell options with high implied volatility. Not buy. Okay, Netflix hanging out at 76. Let's take a look at Netflix real quick. Okay, inside day for now. Netflix, inside day. All right, so Copart, those 35s are 41 delta. Looking for Copart to continue. Okay, we're gapping up this morning. Looks good on the 60-minute. Trending on the 60-minute. A little extended from the 20 EMA, but not too far. 10 EMA. Futures backing off now. S&P, spiders. Yesterday, we talked about the fact that we could see a fade back towards the 9 EMA, the 21 day. The orange line is the 21 day.
PT, FCEL, DLLL, RKLX, LUNR.
RCON.
SLE may res in 10 seconds. DUOT,
EFSA. OSRH.
WETO may res in 10 seconds. NUAI,
Okay, we're looking at stocks that have a pre-market high.
CEL, DLLL,
Where price is above. Okay, for now, the top stocks are Intuit. We had, what was that? Home Depot had earnings. Home Depot, all right, that's back below the 50-day. Home Depot. Lowe's has earnings tonight, I believe, tomorrow, right? Okay, Netflix is hanging in there. NVIDIA looks like it wants to move. Let's look at the New York FANG. Take the market's temperature early. Okay, so we got another day of fading. So if you're buying any of the New York FANG components listed below, just be aware that we are in a fade. So any bounces are most likely going to be sold into strength. There are some outliers like Tesla right now looking like it might want to do something. Tesla did gap down, looking for shorts to cover. Okay, shorts are covering on Tesla. Tesla, shorts covering.
EDRY, NUAI, HSAI, UMAC,
YYAL. WET.
What is SpaceX?
EFSA.
AIFC may res in
SpaceX off a little bit. Cerebras.
BCS.
EFSA, ONDG,
EJH. IPST. BDR.
Cerebras back down to 234. A lot of stocks
HSAI, LGC,
gapping down this morning. Inside day. Cerebras still looking for upside. Brad Gerstner disclosing a position. SpaceX with Harvard disclosing the updated numbers. They were part of the IPO, and the way I understand it, part of the IPO. Now that they have to disclose the amount of shares that they have $2.2 billion position in SpaceX. Okay, it's not like they went out and bought 2.2 billion yesterday. It's part of what we're seeing from the IPO. But we're building the right side of a pattern here. It looks pretty good. SpaceX. Okay, we broke the downtrend. Volume picking up on the move to the upside. So that's telling you that's institutions.
LGCL.
NUAI,
ONDL. ONDG.
LLL,
RCAX.
ONDG, APLX, AMPG,
BCS.
ONDL,
Okay, Palantir showing a little strength. Watching that pre-market high. We want to trade stocks that are above the pre-market high. That sets up the opening range because we're automatically looking at the stocks that are strongest. If we're above the pre-market high, pre-market showed exceptional or noteworthy volume. We're looking for a move above the pre-market high. That's that purple line starting to form on the charts. Monster Beverages. Okay, it's above its pre-market high. Monster, let's see. Earnings were recently, it was a split. And earnings. Earnings were back on August the 6th. They beat by what, a penny? 108 million. I was in Costco yesterday checking out all the sports drinks. I was observing whether or not people had anything in their baskets. Okay, Palantir looking good. Palantir above its pre-market high. So this is already starting to set up a bullish trade potentially. Yesterday, Micron, we were looking at Micron for an opportunity. It winds up gapping down, giving you an even better entry. Still looking for this to build the right side of a cup. It's not going to be up every single day. Okay, pre-market high is overhead, so it might not be right this minute that we'll be trading Micron. Palantir is above the pre-market high. Or this candle closed above. It was on decent volume. So let's see if this can continue and give us an opening range breakout trade setup. Palantir looking very strong. This is a 5-minute. Let me go to the 2-minute. For the pre-market high breakout strategy, you want to be using a shorter time frame, like 1 or 2 minute. Once we close above the 2-minute, we'll ride this through the opening range at 10 o'clock. If it continues to move higher, gives us an opening range breakout signal above VWAP on above average volume, a spike at 1.5 times the opening range volume. We'll get a alert. We'll look to trade Palantir. If it does this, while we're waiting for the S&P to bounce. S&P is moving a bit higher. If you're just joining us, I'm your host, Cousin Vinny, coming to you from theclosingprint.com. It is Tuesday, August the 18th. We're just a few minutes into the trading day. It's 9:41 a.m. Watching Palantir presently giving us a pre-market high breakout, setting up a potential for an opening range breakout. Watching that average volume too. Watching this average volume because it'll give us an idea once we hit the 10 o'clock mark, a heads up that we might see a breakout, opening range breakout. Okay, so just to refresh, opening range breakout triggers when all these conditions are met. Price closes above the 9:30, 10 o'clock opening range high. The bar that produces a 1.5 times average volume of the opening range will trigger a signal. Price is above VWAP. And we need the bar to this opening range breakout to occur in the first 2 hours of the trading day before 11:30. So if those conditions are met, we'll see an opening range breakout potentially. Still watching the S&P at the moment. Coming off the low, 7,700 support. Let's keep an eye. All right, so you can see net open interest. This is non-zero day. Okay, note this is non-zero day. 0 day has a lot more dispersed volume here. That's open interest. Net open interest is what we're looking for. Okay, let's see. There's really nothing on the board yet. So people are not trading yet. You see that? Net open interest for 0 day. Not seeing much. We're at a 99 percentile level at 76.35. So if we lose 7,700, we could head towards 76.35. Make a note of it for later.
The stock this year, this looks like a great chart from the lower left to the upper right. Now, let me go back to pre-pandemic, and you can see that 2021 boom there. I think there was company of the year here. But 180 is where the rubber meets the road. This is just noise until target investors are able to push beyond that. Having said that, they're having a nice
Okay, back to Palantir.
All right, big thanks to Matt, Brooks, and Garrett. Appreciate y'all.
SLE may resume in less
Coming
than
up,
a minute.
Coinbase is John Gandolfino.
Palantir still looks good. All right, so SpaceX is starting to catch a bid. Here's Palantir again, pulling back. Pre-market high break, already fading back to the pre-market high. And VWAP, we want to stay above VWAP for an opening range breakout if we get that around 10 o'clock.
GCL may resume in less than a minute.
It's a good show. It's like, wow. Sure, I know. Start investing with no capital. We talk about ETF investing.
Now here's something that I realized. FGX now. AGX.
WBT. OVL.
Not your fault. UNY. The same company as LY. NMAX. Many sites.
Okay, continuing on with the stocks, the top of the S&P 500, TGRP, TRGP, sorry. Targa Resources, GoDaddy, number 2. Tapestry, retail, Tapestry gapping down this week after the gap down on Thursday. We're basing near the lows below the 200-day, watching Tapestry. This will probably catch a bid into the holidays. Tapestry used to be formerly Coach Brands. We were in a Coach Brands store in the Tanger Outlets a few weeks back with my son. Wound up buying some cologne he liked. Into it again, pre-market high right there. We're looking for, this is the first gauge. Once we see a move above the pre-market high and a close on volume, it starts to set up, okay, we'll need to check out Intuit. We'll make a note, we need to check out Palantir. We're above the pre-market high. The next step is an opening range breakout. We just listed the criteria. Needs to be above VWAP, need 1.5 times the average of the morning volume, 1.5 times the average of the first 30 minutes. That'll trigger an alert and will let us know, stocks that do this, let us know that they are in play and worth considering. If it doesn't have a move above the pre-market high, Adobe does. If it doesn't have a move above the pre-market high or the opening range high, is really no interest. TRI, Thomson Reuters, this one's been consolidating for a few weeks. Not really that interesting. It's at the pre-market high. Airbnb last week, we were looking at this one for a breakout. It's still consolidating. 7 days at the highs. Day 8 after earnings is gapped up. It's holding the highs. That's good. Real estate has been doing good. If you look at the real estate sector, XLRE, there are some candidates there that are worth a look. Airbnb is one of them. Currently above the pre-market high. It's probably going to give you an opening range breakout the way this looks right now. So mark that down as something that you may want to trade today. I'm going to start a new format around 12 o'clock every day, 12 o'clock, more or less. I'm going to talk about investments for the long term rather than spending the whole day talking about day trades and short-term swing trades. I'm going to start focusing on structuring the day so that I could spend more time um, focused on the different areas people are interested in the trading room. Not everyone's interested in day trading, the opening range breakout, or the pre-market high breakout, or short-term swing trades, or sector rotation. They're interested in investing, where they can put their money, what they should be doing from week to week, if anything. So we'll start to cover that at 12. If I forget, um, let me know, and I will revert back to the schedule that I'm imposing upon myself. All right. So DoorDash looks pretty good. DoorDash. So I'm going to do that at 12 o'clock every day. Touch on, may not be adding to, may not be making any adjustments, but just touch on long-term investments for at least a half an hour around noon. Okay. So DoorDash is looking good. It's above the pre-market high, meets the criteria. We're looking for 1.5 times the opening range. That should be easy to do. Pretty low volume for now. The other thing about opening range high and the 1.5 times volume is that it automatically makes us look at the relative volume for the day for a stock. Okay, Netflix is doing well here. Netflix. Okay, pushing. All right. So we know that Netflix, we know that Altimeter disclosed a new position. We're looking for Netflix to push higher. Yesterday, we had some selling. There's still institutions probably trying to accumulate shares. They don't want to do it on a breakout. When we have a pullback towards the 50-day and it consolidates in this area, we're looking for institutions. Right now, it's above the pre-market high, so it's starting to show potential for an opening range breakout. Nice little spike in volume right there. 2-minute chart. Google has a lot of work to do, but it is showing a little bit of life, a pulse. Tesla, nothing there, just sitting flat at the VWAP and pre-market high. Going through the list again, the top 10 on the NASDAQ 100. Paychecks above the pre-market high. Candidate for potential. This has a ways to go. 126.44. You got a $4 move there potentially. Let's check the ATR. Let's check the ATR on Paychecks. Okay, Tesla looking pretty good here. PAYX. Paychecks has an ATR of $3.60. $3.60. It's already up $3.50. So that's going to be tough. Could be it could be a nice little pop though. Keeping an eye on Paychecks. Going through the list. Monster Beverages slipped a little bit. DoorDash is moving up the NASDAQ 100 list. Adobe consolidating. What else? ADP above the pre-market high, setting up a potential for an opening range breakout early. Average volume. Axon above the pre-market high. That's setting up a potential for an opening range breakout as well. It's above VWAP. We just need 1.5 times the average volume. After the first 30 minutes is complete at 10 o'clock. Looking for an opening range breakout in these names. Hope you're writing these down. Netflix, all right, above the pre-market high. This is showing strength. Okay.
CORD. SKGD. SLE may rise in 10 seconds. BCX. AAOC. AIXC halted to the upside. CBRZ. AIXC.
AIXC.
IREC.
Tesla, we got buyers early this morning. 1,500 of the September 5 weeklies. The 327.50 in the money calls for 2.5 million. Tesla, we just showed you Tesla for the last few minutes. It's not doing a whole lot right this minute, sitting on a flat VWAP and the pre-market high. Palantir, we're going to go back and look at Palantir because that was above the pre-market high, not following through yet. DoorDash. Okay, that's holding very, very nice price action. Above VWAP, VWAP's upward sloping above the pre-market high. Where is my desktop clock? Why does that keep disappearing? Okay, there you are. All right, we got less than 4 minutes to go for the opening range. Netflix is showing strength. Okay. NVIDIA showing weakness. Tesla trying to turn up. Tesla. DoorDash. All right, we're starting to flatten out at the high. So pre-market high strategy. Traders are taking profits now. That was a nice little run from 213 up to 220. That's $7 move in DoorDash. Okay, don't chase it up here. Let's see if we move back to VWAP. Give us a second entry, potentially. Dexcom above the pre-market high. Nice volume so far.
PFSA.
PFSA. LGCL may resume in less than a minute. JH.
John, good to see you. Enjoy the rest of your summer. Yeah, see you coming in. All right, straight ahead. Julie Hunt will have one market catalyst. We'll be right back.
DAIC.
CBRZ.
JH. IPST.
IPST.
PFSA.
PFSA.
Oh, this is me trying on hats. So you sell hats? No. So you work for Christmas. I'm just trying to sell myself. Why did you do that?
LGCL may rise in 10 seconds. DXYZ.
Okay, Dexcom still looking very strong. S&P tight at this point. Tight range this morning. S&P. Okay, we're sitting right on top of 7,700.
AIXC may resume in less than a minute.
Non-zero day, we've got a 99 percentile level at 77.50 overhead. There's not a whole lot to see here today. 77.50. We got this level down here at 76.35. So 76.35. and 77.50. Okay, so I'll mark these up and put these in the room.
ST halted to the outside. IPST. AMLX.
LGCL,
AIXC may resistance IC.
EJH,
EJH.
WFF, IPST, EJO,
IPST. AMLX.
LGCL, EJH, SLE,
AIXC halted down.
Okay, it's 10 o'clock. Opening range breakouts will start to appear.
WFF, IPST,
Okay, let me just post this in the trading room. Watch the S&P. We would like to see the S&P help us. You can see where we are down here. We gap down, trying to climb back in the range. Gravity alone suggests that any longs are susceptible to failure. Shorts most likely will continue to work unless we start to show some signs of a bounce. Okay, there goes Apple. Apple's on the move. Okay. Pre-market high is overhead. Opening range high is right here, right now. Okay, opening range breakout on Apple. Apple, opening range breakout.
Data may resume in less than a minute.
Opening range breakout. We're about to take out the pre-market high. Something's going on with Apple. Let's see if there's any news. Let's see. Nothing new. Okay, so it looks like it's going to try to get back above the 50 days. So let's see if this continues. Apple. Apple. Okay, Apple has an Apple has an ATR of approximately $7.30. Currently, we're trading up $2.65. All right, so we're looking for $4 to $5 upside here from Apple. A 50 delta call. If it moves 2 points, the 50 delta call will net you $100. If you take 5 of those, you make 2 points on Apple from here, from 309 up to 311. Those 5 calls should net you approximately $500, $500 a day. Average, if you do that on a consistent basis, that amounts to about $10,000 a month. A goal that we constantly talk about. So Apple, let me take a little Apple here. 20 for make sure I take the right expiration. Okay, I'm going to buy the 45 Delta 310s are only 263. Buy a couple of those. See if we can follow through. All right, so I'm looking for 2 points minimum. That would be $100 for 5 contracts. I just bought the at the money 307.50 for $2.69, $2.70 now offer. I got it for 268, 270 offer, 273. Keep an eye on Apple's level 2. One thing I don't often talk about is when I'm trading, I'm also paying attention to level 2 and time and sales because it could tell us if there's overhead selling pressure that we're not looking at or that we don't presently see. We see a lot of green so far, looking for Apple to follow through. Again, I bought the 307.50. The 310s were a 46 delta. That's close enough for 50 delta to be worth a shot. Those are going for 270. The 60 Delta, that's the 307.50. Those are going for $4 offer. The 312.50, that's the 34 Delta starting to climb. The Deltas are starting to climb here. 34 Delta, that'll set you back $174, $170 per contract. Split the bid and the offer. Okay, this is Apple. We'll keep an eye on Apple for a few minutes. Also want to pay attention to what's going on with Netflix. That's up on the day. Apple looking really strong. Okay, Apple's IV rank has been rising. It's at 35%. Implied volatility is 25%, so calls should be pretty cheap, right? Okay, Apple calls should be pretty cheap. No? Well, that's knocked me over with a feather. 97 percentile. Okay, buying put spreads is a suggestion. We're breaking higher. Opening range breakouts triggering. We're above 309.28. Apple is breaking out. Successful trades so far on Apple. Buying the 307.50s or the 305s. You can use the 312.50s as well for Friday. Looking for a follow through. Okay. Starting to see opening range breakout volume. We're at the 50-day, so we have to be mindful that we could get rejected here. So the object here is we want to ride this until we start to see red candles. If we start to see 3 red candles in a row, pay attention because it may be a reason to exit the trade. If it doesn't happen between now and 10:30, the next area that we want to pay attention to is 10:30. Reason being is a lot of people on the West Coast that might be trading or Mountain Time might be trading. They get up early in the morning, say 6 o'clock, to trade the 6:30, which is the 9:30 open here in New York. They get up, they trade for the first hour or so. That lines up to around 10:30 or so, 10:30, 11. We're looking for strength through 10:30 to 11. If it doesn't happen, we start to get into that zone and start to flag out. That's a good reason to start to take some profits off. This is just purely for day traders. The mindset. A lot of times I don't explain what I'm thinking. And Friday, some of you got caught. You bought Tesla. It ran up in the morning. It had a pre-market breakout. It had an opening range breakout. And then a few minutes later, it decided to dump. And it looked like a sell program the rest of the day on Friday. If you check out the chart, look at the 2-minute chart, you'll see what I'm talking about. Tesla. Okay, you can also see it on the 60-minute time frame. Okay, here's Friday. We popped up to 351 and we sold for 2 hours straight before consolidating and firming. We're at the 20 EMA, looking for Apple to get back above the 20 EMA. That would help. It is. Okay, so we're above the 20 EMA on the 60-minute time frame. This is another way to look at the pre-market high, opening range breakout, and put it together with a higher strategy idea, which is the stock above the 20 EMA? Is the 20 EMA on the 60-minute trending? Is it flat? Is it descending? All of these things we need to consider. Right now, we're flat to slightly higher, and Apple's looking pretty good. Let's see if we can't get a follow through here. We don't want to go green to red, so we're looking for a continuation volume. All right, we're starting to see a little bit of selling volume here. Netflix pushing a bit higher. Apple, okay, opening range breakout signals continue to show up. We'd like to see volume spike up here again, get another one of these little green triangles. What is this telling me, Vinny? It's telling you that the stock is in play. In order for this to happen, the stock needs to be in play. okay, or vice versa. The stock is in play. That will create the opening range breakout strategy alert. We're above VWAP. We're greater than 1.5 times the opening range, first 30 minutes volume. You can see average volume here, first 30 minutes. Okay, I've traded the opening range for years. I just never put together the 1.5 times volume breakout or the pre-market. I have to credit S&B Capital for that.
PST may rest in 10 seconds. SAGT. SOXS. AIXC may resume in less than a minute. LTC. CBRC.
Okay, looking good. Apple's still pushing. All right, so if you're day trading this with options and you have Friday calls, you want to make sure you got a order ready to go. If you keep your Thinkorswim trade window open with a limit order, it will automatically move with price. So it'd be very easy to take a limit order with a little slippage, very little slippage. So far, this is looking pretty good. Apple. Okay, I took more than I was expecting to take. I actually took 20 calls. I'm going to sell half of these already. I'm going to sell half of these Apple calls right here for a nice profit. Okay, so I just sold half of those. Just sold half of those 310s. I had some 312.50s left over from, I guess, a couple of weeks ago. Those are possibly in play. All right, watch right here. So people are taking profits right now. You know, this is a nice move from 306 up to 310, $4. $4 on a 50 delta call. That's $200 per contract. All you need is 2 to 3 options and be lucky enough to buy the dip. I don't like buying the dips because you don't know if it's going to keep moving lower. I like a strategy where you have the opening range breakout or the pre-market high is setting up the trade, so you know it's in play already. And then you get to follow through and confirmation with the opening range breaking out. Free script, by the way. This script's available on TradingView. I have it for Thinkorswim too. If you're interested, just drop me a note, a DM, or drop me an email at Vinny at theclosingprint.com. I can send you the script. It's pretty straightforward. Like I said, I've been trading this for a long time. It's got to be over 30 years, 35 years. The opening range breakout. I forget who mentioned it back in the day, but I never put together the 1.5 times volume. That part, I don't know why it didn't seem obvious, but started thinking about relative volume. Grover, when did we start talking about relative volume? About 3 or 4 or 5 years ago. Again, that was a observation from S&B Capital. I have to give a lot of credit to the videos that S&B Capital. You can check them out at S&B Capital on YouTube. A lot of good training videos, a lot of good ideas. Implementing the ideas, however, and trading it live while you're watching, that's another ball game altogether, because once you put money to work, it becomes a little bit more difficult to utilize the strategy. It's great to have a strategy, but if you don't trade it live every day or post the results every day, you can't see your statistics. And in this case, we've got Apple still in an opening range breakout. A little bit of selling here. We don't want to see a third red bar. All right, so far, this is looking good for continuation. The sell point would be if we get 3 red candles, we'd be ready to get out. If we see a 4th red candle, we'd be done, okay? Now, I'm using a 2-minute. You could use the 1-minute, but that's going to be a little bit more noisy. Scalpers might want to use the 1-minute. I like to use the 2-minute. It's a nice in between. 1 minute, 5 minute. Apple's still looking good. We're pushing above the 50-day on the daily on the right over there. You can see that. So Apple, very successful trade so far. Okay. So if you got into that, as you're starting to make 50 cents, a dollar, if you're new to this particular strategy, you make 50 cents to a dollar, maybe you start to scale out. I took 20 by it. I don't know how I did that. I have my toss set. Oh, I see what I did. Okay. I see what I did. Okay, here goes Apple going a bit more now. Okay, we just want to go check out Apple on the 60-minute. This is looking good for a longer term trade as well. As we already got into this trade, what, 10 o'clock, 15 minutes ago. All right, so 15 minutes have passed. We're a little bit extended. We've got ATR. What did we say Apple's ATR was? $7? $7 and change. So let's just say $7 on Apple. It's currently up $4. So you got another $3 potentially. Even though it dipped, I don't really count it, but even though it dipped into yesterday's price range, we got potential for $7.50 upside. Currently, we're up $4.50, so maybe another $3 if we stretch it. That would be 100% of the ATR. I promise I have had no. Here it is here, David. Check it out. Right here. See it? Why is it so good, Vinny? Well, I tell you what, opening range. All right, watch Apple. Apple, you might want to watch profits here. Yes. Okay. Give me a minute. Give me a minute. Still in Apple trade. Okay. So I'll send that script to you. If I forget, just let me know. Okay. The reason why it works is because it tells you a stock is in play. In order for volume to exceed the first 30 minutes of trading, in order for a stock to get above the pre-market high, if it's trading pre-market and you got a lot of volume in the pre-market, you see Apple, how much volume traded in the pre-market, and you take the pre-market high. If the stock can maintain the pre-market high, that's a good probability, a high probability that you'll see a break above the opening range. We did get that so far. Those two were synonymous, right? Oh, there's the opening range high right there. Okay, opening range high, the orange line, opening range high for Apple. Okay, I got Palantir on here. Let me just change that. Okay, so right now we're looking for a second trade potentially. That would occur if it pulls back towards VWAP. We're looking for a B and C pivot. Why does that happen, Vinny? Because the B and C pivots typically happen as traders on the West Coast get up early, 6 o'clock in the morning. They're ready to trade the open. 6:30. Their time is 9:30. Our time for the opening bell here in New York. They trade for an hour or so. It's 7:30, 8 o'clock. They get ready as the trade is working. They exit the trade around 8 o'clock. They go to work, depending on how long it takes them to get there. If they're in mountain time, same idea. All right, we're already starting to see some selling. Apple, I'm out. Okay, I'm not going to wait for a third candle right now. I'll wait and see if this pulls back to VWAP. Only because I'm broadcasting, it's a little bit harder for me to juggle too many balls at the same time. Netflix was also a opening range breakout candidate. We don't have the volume though. See the difference? Okay, we don't have volume. So this is telling you, although Netflix is moving higher, it's not like a day trade in the in play status, right? We don't have the relative volume, in other words. So Netflix is looking good. It's above the opening range high. It's above the pre-market high. These two levels, pre-market high here. Okay, pre-market high. We're above that, and the opening range high. So we're above both of these. That's telling you, I don't want to say it's in play because I don't want to mix it up with the opening range. But it's definitely at least seeing some short covering or some new buying. Okay, so here's your opening range high. There's your pre-market high. Okay, watch for 3 candles. If you go to the 1-minute chart, it's still hanging out at the high. So this looks pretty good, actually. Netflix, it just doesn't have the in-play status that Apple does. Okay, Apple's already given you an exit. So that's why I took the exit. This is a 1-minute chart. You can use the 2-minute chart too. You got 3 red candles. That's reason to get out. All right. You didn't get a big home run here, but we moved from 308 up to 310. So that's 2 points for a 50 delta call. If you bought those 50 deltas, those 2 points net you $100 per contract. You should have seen that. Implied volatility probably adds to that. So 5 contracts, 2 points, $500, $10,000 a month if you average $500 a day. So it's a strategy to take, all right, I'm going to take the opening range or the pre-market high. I'm looking for 2 points. If I buy a 50 delta call, each 50 delta call, if you gain 2 points, is going to net you $100 just using options deltas. That doesn't include implied volatility, an increase in IB rank, or any catalyst like news or whatever. So 2 points, $100, 5 contracts, 50 delta call, $2, $500 a day average. You're not going to have every day is going to be $500. Sometimes you're going to be less than that, but if you can do $500 a day average, that's $10,000 a month. I know I'm beating it to death, but that's for new traders that might be listening to the opening range breakout and how we utilize it to make some nice gains. All right, so we're already fading. So Apple, you've already probably exit this one already. Let's look at some other candidates because the opening range lasts until 11:30. The opening range breakout signal, Adobe. Okay, these are already starting to show signs of a fade. DoorDash. Okay, DoorDash is not, it faded a little bit, but it recovered very quickly. What's Tesla doing? Tesla, we saw 1,500 contracts trade on the weeklies. Nothing yet. Netflix, you can sell, put premium. We did that. I was coaching a trade with Sean, one of our new members, for Friday. Apple, we took profits there, Sean. Okay, those first 3 candles. Okay, look for another bounce. Yeah, it's a good book. Good book. Yeah, Mike Bellafiore. Yeah, he's good. Okay, Netflix is still going here. All right, watch for a bounce in Apple. This is probably just profit taking. Okay, so looking for more upside. For scalpers, you want to use the 1 or 2 minute chart. We're already starting to turn there, Sean, so you might get a nice opportunity to sell some into 310. Only reason I took profits is number one, we got the 3 red candles on the 1 minute. That translated into the 2 minute. I took half off already into the strength. And then as we start to move lower, I took some profits off. So I'm looking for another bounce, for another trade. Yes.
You may rest in 10 seconds.
NCGT.
GST vaulted down.
EFNC.
CRC. CRCG. GRU.
EFNC.
Okay, we're still fading Apple. Okay, don't let it go. Don't let it go.
CRCG. CRCG.
EFNC.
CRC. CRCG. SLB vaulted down.
EFNC.
CRC.
EFNC.
Okay, S&P is trying to bounce.
MSTP. WBT.
Okay, Google is on the move. Or watch Google. Okay, Apple's working okay. Apple's starting to bounce. Do not let it go green to red. Okay, Google opening range breakout, no volume. Okay, you see the difference? You got the first 30 minutes, but you don't have an opening range spike in volume, 1.5 times the average volume. We're looking for that in play status.
WBT. RCON.
One sec. Let's see. Let me run. Okay, NVDX, NVDX, NVDX. Okay, let's look at the 60 minute. Okay, gap down. Okay. Watching the 60 minutes oversold now. So that means let me look at the 5 minute. All right, we're starting to turn right now. All right, so that looks good. 2010, 2010, first target.
IPST, EJH,
Okay.
TJGC, IPST, RC overhead, IPST, SXTC,
CMRCG.
Okay, we got a nice little bounce, and I'm looking at NVDX, NVIDIA bouncing so far. Okay, looks pretty good actually. NVIDIA, we got earnings. So if you were looking for a dip in NVIDIA before earnings, this is your opportunity. Is it a guarantee? Does it move higher? I don't know. I might take a shot. Well, I'm not going to take a shot because the opening range is right here. The move off the low already started, 219 to 220. I'm not going to chase it right now. Looking at opening range breakouts, though, we still have an hour to go. The strategy works between 9:30 and 11:30. Price should be above VWAP. Volume should be 1.5 times the opening range, the average volume of the opening range the first 30 minutes. If those criteria met, it's going to trigger a signal like we saw with Apple. Apple breaking out again. Good job, Apple.
WBT, IPST, SLE, WBT, IPST,
WTO. with a drug trial result. The company is testing an experimental drug to treat dangerous blood sugar levels that can come for some people after bariatric surgery. And it had a late-stage trial of that drug, met its endpoint, and so investors are very enthusiastic about that. The stock has more than doubled just for this year. Analysts also enthusiastic. People saying this was the best WETO.
IPST.
Coming up next, inside Amazon Electric
SXTC.
invested on AI.
SLE.
All right. So for those of you who asked, let me just give you this script while I'm looking at it.
WETO.
SXTC.
EFSA may resume in less than a minute.
SLE. RCON.
RCON.
FGI.
FGI. EFSA may rest in 10 seconds.
RCON. IPST.
RCON.
All right. Apple is gone. Okay. Apple's looking really good. This looks like an opening. Looks like a nice breakout in Apple.
RCON halted to the upside.
RCON.
RCON.
Opening range continues. Apple, those calls have increased superbly.
WETO may resume in less than a minute.
Okay, note where RSI is. Okay, so if you're buying up here at the high, RSI has a potential to roll back over. If you're looking at the short time frames, if you're looking at like a 5-minute, 15-minute, okay, we're still overbought. So it looks there's a lot of buying pressure here. A lot of buying pressure. Looking for more upside and Apple. Apple looking good. Okay, there goes Amazon. All right, the New York Fangs are waking up all of a sudden.
EFSA.
Okay, it looks good. Okay, Apple on the 60-minute time frame, you know what we're looking at here. Okay, so as we progress through the day, one of the things we always want to check is, okay, I have an opening range breakout. Everything criteria-wise looks good. The stock is in play, Vinny. What about a swing? Well, if you watch the 60-minute 20 MA time frame, 60-minute 20 MA, once the 20 MA starts to turn and break the downtrend in this case, we have a range. We need to get above 316. But this is setting up for a longer term horizon. So you'd want to have something beyond Friday, maybe Maybe you're looking at, say, September or October. Okay. So you're looking for a break above this range. If we can get above this pivot over here at 316 and change, we get above this level, the moving averages will have already turned up. So we're ahead of the game right now, just from the standpoint of, have we bottomed? I mean, Apple, I went by Costco. I was looking at the products. I do want to have another laptop. I have three already, two already, plus an iPad, plus two Mac Minis that run the show and my main Thinkorswim. When I say a need or a want, it just means that it's something that'll slate. I'll replace this laptop at some point. The prices have gone up, but they're not like too crazy. 60-minute on Apple. Okay, so that 20 EMA, we want to see that 20 EMA turn up. Okay, so that 20 EMA needs to turn up and continue to move higher. Okay. If we can get the 20 EMA to start turning higher like that, that is what we're looking for. Also watching RSI. All these things are giving us supporting levels or steps to push higher. Only reason this is going to continue is because institutions are buying. Okay, we continue. This is looking really good. So this is going to probably go. All right, we're at 1040 now. So remember what I said earlier about taking profits into strength, that you might or you will run into a situation where people that have bought, some of these people are going to start taking profits. We've already seen that a little bit already. People on the West Coast that trade the opening and then go to work. All right, so this is showing strength, more volume, looking really good for Apple. Okay, let me look. Okay, look in there. Okay, so Apple. Okay, looking for more upside. Okay, watching this, watch the 1-minute chart at the highs, Apple. Okay, what we're looking for is profit taking. That'll occur if we see 3 red candles in a row or more. It's not a set in stone criteria, but if we start to see 3 red candles on a 1-minute chart, that's telling you that there's more selling than buying at the moment. Okay, we're starting to turn down. I would take some profits, more profits off. Okay, more profits coming in, profit taking. Okay, Netflix still pushing. Apple's looking strong. At this point, I'd be looking for a move back down like we had earlier here between 10:15 and 10:30. Okay, starting to move a bit higher now. Okay, Apple. Apple looks good. Okay, so we don't want to lose sight. We've still got an hour and 15 minutes or so. I'm sorry, 45 minutes or so. 45 minutes for the opening range. Strategy into it. Okay, that dipped. Looks like it might do something here. If you like into it, had a nice dip back to VWAP. This could be a nice trade here. Into it. Monster Beverages. I'll pass on into it. Monster Beverages. Very strong move here. Earnings was the first week of August. They beat by 108 million. Basically flat. Estimate was for 29 cents. They came in at 29.296. Reported 30 cents. So they beat by a penny. Netflix is still going here. Netflix is looking good. Okay, we're breaking out above Friday's high. Netflix breaking Friday's high, looking good. Apple flagging. I would take more profits than Apple.
NBIC. IREC. RCON may rest in 10 seconds.
Okay, Apple take profits.
ST may rest in 10 seconds. NBC.
Yes.
This year, we see a super El Nino that
Okay, we got about an hour. We got about 40 minutes to go for the opening range. Okay, Nvidia bouncing off the low. Okay, this pretty whippy price action, choppy. Apple looks like it wants to keep going. Apple very strong, showing a lot of strength today. Apple, we have a $7 ATR on Apple, remember? Okay, so Apple is currently up 534, and we might see $2 more.
AMKX may rest in 10 seconds. ST. ST.
Okay, S&P is rolling over a bit, so we got to pay attention to S&P as well. That'll drag a lot of things with it. Okay, hedge flows are moving lower. Okay, let's look at the S&P. A lot of stocks are moving opposite. Okay, for now, it looks like it could be a doji day, right? A doji day doesn't go anywhere. Let's see what up-down volume says. Up-down volume of 1 to 1 would tell us that what we're seeing is believing. 1 to 1 up-down volume would tell us to look for a doji day. Nobody's winning. So let's take a look at up-down volume. Pulling up-down volume. Okay, it's 1 to 1 down on the SPY, but almost 3 to 1 down on the Q. So Q's not working here. Q's gap down.
AIFC may rest in 10 seconds.
Okay, S&P is still fading. S&P is still fading. SPY doesn't look that bad. Let me take a look at RSP. RSP, the equal weight index. Equal weight is actually bouncing. Go figure.
AIFC halted to the upside.
And so I think, again, it is one of the hardest things to wrap one's head around in this one cooling cycle. And the
IPST,
is driving
SL,
is where the backs
AIX,
but they are coming.
AIFC.
Those losses,
SOXF.
$1 billion mark, which is maybe 80% of global GDP are already baked in. So unfortunately, we should expect this to be a drag on the economy in 2027.
Well, and then Colin, as I mentioned, what is sort of incredible about all this.
Okay, so we've got the 9 EMA, the 21-day, and the 50-day up and to the right. The equal weight index still pointing higher, trending. So we are selling a bit. A lot of that has to do with NVIDIA. NVIDIA is not cooperating. Neither is Microsoft. So some of these tech stocks that bounced recently, seeing profit taking. Meta trying to turn, Broadcom trying to turn, Snowflake. Netflix, though, Netflix is doing well.
As I mentioned earlier, having the BIS instead of expanding infrastructure.
And so our calculations take account of the fact that those losses occurred in the first year, but they materially altered the growth trajectory of those countries moving forward. Another factor, for instance, we know from a study here in Nature that the risk of conflict
SOXS.
MUC.
SKGD,
Of course, if you have
That's healthy.
on
IREC,
that is likely to last several years, you're likely to get even more damage to those economies.
S&P still, all right, that's the low right there.
NTWO, AAOC, GDXD, LITC,
SGLY.
GDST,
Okay, number of stocks advancing. Looking at the number of stocks advancing, we got 330 stocks advancing. So I don't see a big dip here.
RAMZ,
BFSA. SGLY.
AAOC, GDST,
So multilateral development banks like the World Bank, Regional Development Bank,
SKGD,
IMF should begin repping up concessional credit facilities now before the impacts hit.
All right, so we got 330 stocks advancing out of 500. You've got the equal weight index showing strength or holding on to the 9 EMA. We could pull back to the 21-day. We got Brent talking about potential for a rally, at least until into tomorrow. We did gap down, obviously. Amazon looks like it wants to go. IPST halted.
SNDQ, SOXS,
BFSA.
IPST.
BECST may resume in less than a minute.
IPST. What'd you start this at yesterday, Mondo? Wow.
AIFC may resume in less than a minute. GDXD, MZ,
XOS.
SNDQ, DUST, LTZ, SOXS, SKGD, ZSL, NBIZ, NTWO, MUC,
RCON.
AAOC, GDXT, IPST may rest in 10 seconds. DG,
XOS.
Can't change the pill, but can change.
LITZ, SOXS may rest in 10 seconds. ZSL,
Okay, looks like IPST is on the move again.
SNDQ,
Okay.
IPST.
Download this page today.
GDXD, AIFC halted down. DP, MWC,
Okay, I'm going to take a 5-minute break. I'll be right back.
NTW. DG.
IPST on the screen.
ST. AAC. IPC. System and voltage site. NPIC. SNTQ. AAC. TZ. GDXT. SOXS. SKTD. MUC.
IPST.
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 AISC may resume in less than a minute. OBI. NY.
IPST.
IPST. AISC may rest 10 seconds.
IPST.
NTWO. IPST. PONY. RCON may resume in less than a minute.
Yeah, so basically, what is that? IPST.
IPST. Take it silent. RCON may rest in 10 seconds. IPST.
IPST.
Take it silent. NTWO. SLS. SMMT. CAST.
Okay, IPST continues to run here. What's the news?
NUP. PONY. IPST multi-task.
Okay, that's a risky one to trade, people. IPST. It's up to you, but whoops. Okay, S&P 500 holding on. Looks like it's going to be a doji day. The selling is in tech, which might be an opportunity on this dip, this doji that we're looking at here. This doji. Okay, I would anticipate that we're going to see more selling first and then an opportunity. I mean, we had this really huge run from the end of July into the month of August, flagging an upward sloping flag. So it's been a good month. It's been a good couple of weeks, I should say.
GDXT. AFC may rest in 10 seconds. SKGD. GDST. MC.
Okay, S&P just sitting here. Okay, Apple still showing strength. Apple still showing strength. Okay, so it might be done for the day. It has a $7 ATR, 750 ATR, but it's up over four and a half, $5. So might be done for now. Look for a dip back to VWAP, maybe another run to the highs. Let's see what's going on with Apple. Apple's foldable could lift iPhone prices 11%. Okay, there's your catalyst right there.
IPST may resume in less than a minute.
INHT.
AMLX. AMLX. NTWOW.
Okay, let's look at net open interest.
AMLX.
IEST.
IPST is on the move, huh?
LOTD. SLE. IEST.
All right, let's see what Microsoft is doing. We're coming into the end of the opening range window.
TO may resume in less than a minute.
Let's see.
AIST may resume in less than a minute.
Okay, Apple's at the high. Let's see, Microsoft trying to do something. You can see opening range high and pre-market highs up at the high and a flat VWAP that's telling you no trade.
IPST halted down NY.
Let's see. Let's look at maybe some iron condors for earnings. What's playing earnings? Let's see who's Lowe's is tomorrow, right? Lowe's, Target. These are looking at 5.5, 6%. Lowe's is looking at 4%. Okay, Lowe's. Let me take a look at Lowe's. So 4% on, let me just take a snapshot of this while I'm here. Okay, and then tomorrow we got Walmart, 4%, Baba, 5.7%, and Advanced Auto Parts. And that's it for the week, right? Okay, so let's look at, what do we look at? Lowe's. Let's take a look at Lowe's. LOW. Okay, so mostly positive gamma. We got support at 195. Let me look at a chart of Lowe's real quick. I'm going to kill your eyes going back and forth, dark to bright. Sorry. Lowe's, let's say 205 is a big level. 205, 195, 195, 210. Okay, so 195 is a big level. So if we sell puts down below 195, let me just set this up for tomorrow. Earnings. Lowe's, LOW. Let's see what Home Depot looks like. Home Depot was up this morning, gapped up on earnings. It beat expectations. So these are single digit earnings growth and revenue growth. So it's a nice steady trade. Home Depot, I could sell some premium at Home Depot, right? Home Depot, let me just check Home Depot. I mean, is it too late to sell Home Depot iron condors? The implied volatility likely is already drained out. IB rank is 56%. IB percent is 28. Okay. Builders. I think I have it under builders, right? Take off this. Builders. Home Depot in here. Lowe's. No, let me put these on here. HD. LOW. BLDR. Builders First Source. Is that on there already? Yeah, it's already on there. Okay. So where is Home Depot is here. Selling call spreads. Okay, implied volatility has already dropped to 27%. It was at over 40%. 1 month implied vol is 30%. Realized vol is 26.98%, so it's a little bit elevated. 1 month IB is 71%. Slightly expensive IB relative to its history. Okay, so we'll come back to that. All right, looks like Microsoft wants to go here. All right, so I don't want to leave off there. I want to look at Lowe's. Let's see what Lowe's is doing. Lowe's is over here. 1 month implied vol of 79% of its 52-week range, indicating expensive IV relative to its history. IV rank is 79%, so we want to sell premium in this situation. Okay, it's suggesting selling call spreads on Lowe's. You can see what Home Depot did after earnings, and they beat single-digit earnings growth, single-digit revenue growth. It's a money maker. They continue to make money. Question is, do I want to sell Lowe's with earnings tomorrow, or do I want to sell Home Depot after it already reported? Okay, let me look at it on a weekly time frame. I'm looking at Bollinger Bands is what I'm thinking of. Bollinger Bands, okay, the lows are 295. We said 295, 195. What? Oh, I'm looking at lows. That's why. Home Depot. $350. We got 315. 315 is right there. We got a lot of positive gamma at 315. So the dealer would hedge this by buying shares. Okay. Microsoft's still looking good. Home Depot, I'll think about Home Depot. And Lowe's, maybe an iron condor there.
I may resume the last CAST.
Okay, Home Depot still pushing lower.
I may rise in 10 seconds. AIFC may resume in less than a minute. OSRH. AISC may res in 10 seconds. CAST.
Okay, Home Depot fading a bit. All right, Lowe's. Big range, Lowe's.
AISC vaulted down. CAST.
Mm-hmm. All right, what's Shake Shack doing? Shake Shack. Trending, Shake Shack. S&P is just kind of range bound, not moving much. Not expecting much out of it today. We just hit a new low. Super micro gapping down. Tesla still chopping around VWAP. Tesla. Intuit, the top 10. DoorDash. Grinding higher DoorDash.
may res in 10 seconds.
Amazon. Is Bezos finished selling? Do we know? Intel gapping down. The chips are moving lower.
INHD vaulted to the upside.
IPST fading. Okay, so be careful with these. Autodesk. Okay, has earnings coming up. Autodesk. Lowe's has earnings tomorrow. Lowe's for 28 August has hardly any options. Got a lot of open interest in September monthlies. Lowe's, let's see, Lowe's, L-O-W, L-O-W. Lowe's with a bounce, 235.
INHD may resume in less than a minute. may rest in 10 seconds.
WBT.
Okay, we're 11:30 on the East Coast. I'm your host, Cousin Vinny, coming to you from theclosingprint.com. It is Tuesday.
Thank you very much for joining me today. Look, there's a lot going on. So let's
11:30.
because we're in the middle of the season. It's the big week. We're only got about 150 names.
MRCY.
So give me your sense on where what we've heard so far, which has been stellar, and where you think we'll go.
So I think we're gonna continue
Yeah, I
with this week. Growth has just been phenomenal. And having said that, I think when we get discretionary names, that's where we have to see good amount of weakness, and we'll also get forward guidance that may surprise.
Right, so we'll pull down.
WBT.
Right now, I think they could be growing about 15 or 17%.
TLIH halted.
But I think once you start to get those weaker numbers, that number will come down. It'll be good overall, but it won't necessarily be this picture I think we're looking at right now.
AIX.
Yeah, I think we're gonna have some very good reports from earning numbers.
Okay.
INHD may
Lows, we said.
WBT.
So, I think it's gonna be a bit of a mixed picture, as long as there's all this stuff up in the air with Iran. We just keep swinging back and forth about it. It's like, so. Do you think the AI
200. Big negative gamma bar there, 200. What we look to do is when you're selling premium, you want to sell where these lines flatten out. On the call side, the premium's pretty extended, so selling call spreads make sense. Above 240 or so. Okay.
INHD may rest in 10 seconds.
AIX.
To the tacos way back to back from 2000. There's a lot. And so I do worry in particular about hyperscalers because they have been more. They came out and forecast that they need to get to
Okay, what's Apple doing? Apple fading.
IPST.
Okay, so we're looking for a second trade
Halted down.
in the evening session. Right now, the morning session's traded out, so you really don't want to do too much at this point. If anything, take a break, go take a walk around the block, ride a bike, go hit some golf balls, go to the beach, whatever. Because the main part of the day, if you're going to day trade, is done between 9:30 and 11:30. Now we're looking for an A pivot, the high of the day, playing out the ATR, which is one thing I need to do here while I'm thinking about it.
CAST. IPST.
of many of the AI related plays. And so you may very well find that there's a lot more reward that investors give to those companies that do still have strong positive cash flows that are being more careful with how they spend, right? I mean, for a few years now, the philosophy has been the greater risk is to not spend enough.
Right.
That's changed. Now I think the greater risk is to overspend
CAST.
in this environment, especially if one needs to.
IPST.
Well, at what point do you won't spend it? Look, Google just came out and said they raised their number to $2.5 billion, right?
70% to go. He has some ridiculous, like 150, 300 million, some ridiculous amount of shares, Corey. Yeah. Between him and between he and Elon. nice to rule the world. It's just so funny looking back at with how Amazon started with him on a desk in a dingy office with a hand painted with spray paint Amazon logo and where it's gone. I mean, it was such a great idea when you think about it. You didn't have to worry about how products would be paid for because the credit card infrastructure was already in place. You know, you had to code a website where you could buy products for cheaper than you could from the store and have it delivered. So who's delivering it? You already had the delivery service in place, UPS, FedEx. So you pay for the delivery service. And over the years, finding out ways to cut the cost, build warehouses near airports all around the country and provide products same day delivery is crazy, right? Speaking of that, I got to get my son a clear backpack.
INHD may resend in less than a minute. GIZ.
Oh,
C may resend in less than a minute. CDTG. NBIZ. INHD may rest in 10 seconds. AIFC may rest in 10 seconds.
okay. Apple looking good. I find it hard to trade during this time of day because there's really no strategy attached to it unless you know one. The middle of the day between 11:30 and say 1 o'clock, it's kind of like a dead zone. So it's a good time to take a break. All right, let's see what we got going here. So lows. Okay, what's Netflix? Netflix having a good morning. Okay, opening range high. We never got an opening range breakout signal, but we did move higher. We're above Friday's high, which is good.
NBIZ. INHD vaulted down. CDTG. NBIZ. vaulted to the upside. Daily IC. CAST. CTJ. SA may receive less than a minute. CAST. SA may rise in 10 seconds. CAST. INH 10 may resume in less than a minute.
All right, looking for more follow through.
CAST.
Netflix. Just watching, monitoring the slow part of the day, and doing some admin work. Admin is off this week. Netflix. Let's see. Target resources. Target resources. Gapping up. All right, let's look at the. Let's see what how the watch list is doing. Many of those stocks look good this week. Watch list for the week, August 16th. AAOI pulling back a little bit. Apple, of course, moving above the 50-day. AMD back below. ASML. All the chips getting sold today. Banks have been steadily rising. Citigroup back to the 50-day. Citigroup has the best price to book for a turnaround play. Citigroup, it's got a price to book of about 1, I believe, 1.1. JP Morgan, by contrast, has a price to book of about 2.5, much higher, regarded because of its strong balance sheet and its earnings. But Citigroup got a nice turnaround story underway. You can see that it's been rising on the weekly time frame. Longer term play, currently pulling back a little bit, offering an opportunity for an entry. If you're interested, Citigroup, let's see what else. Copart, this is one I'll probably start adding to. This is one that Grover mentioned last week on Friday. Okay. 60-minute, 20 MA strategy on Copart. Okay, you break the downtrend. Let me go to the 2-hour, give you double the information. Okay, you can see the downtrend that has broken, making higher highs and higher lows. You don't want to buy it right here, right now, but it has slowed down a little bit today. It's just moving sideways from the open. If you look at the daily, you can see pretty solid Friday, followed through yesterday, continuation today. We got over 300 stocks advancing, or did. Over 300 stocks advancing out of 500. 300 stocks advancing out of 500. So that's more than half. The Qs have 52 stocks advancing out of 100. Core 1M is at 945. So Core 1M is starting to give us some good information as far as calls are getting whacked. People have been chasing calls. As I advised, when Core 1M is low, you want to be thinking about taking call spreads instead of taking calls, just straight calls, because you're chasing, and the implied volatility is high, and IV rank is high. So any pullbacks, you'll get whacked doubly hard. So we've been taking spreads for the most part, and most of our trades have been out in September, October, and later. December, I got a few positions in December. Copart, I think I have, what do I have on Copart? Copart, I took this when Grover mentioned it. Okay. December 3540 calls. December 3540s. Okay. That looks good. Those are $1 each. Okay, so you can get into Copart for $1 for December 3540 call spreads. Home Depot had earnings. Let's take a look at Home Depot. This is the time of day to do some study, do some scans, consider some trades for later in the day or tomorrow. The bulk of the trades for the open range breakout and pre-market high breakout are done. The window between 9:30 and 11:30 is generally where you want to look for those trades, those setups. What's moving today? Okay. SOXL. SOXL. Okay, down a little bit. Okay, S&P climbing a bit. What did Brett say? Brett was saying he favored call flies into Friday, did he say? Let me see here. Let me just check this out real quick. Right here. Okay. Wednesday, VIX expiration based on gamma, short dated call flies are still preferred way to play upside. So if we do bounce, call flies can do well. Let's see what those go for. SPY call flies. And then I want to check hedge flows. Kind of bottoming here. All right, can we get back to 77.50? Probably. S&P 500. SPX. What do you say? What do you say here? Short dated call flies. I can't understand you.
Can I get the bacon now?
Yes, yes. Please.
I worry that it's not consistent. I guess there's like different Fed officials come out and say that they
AIXC may rise in 10 seconds.
so it is a little bit chaos with that. If it was maybe something that was more like a more regular release and everyone had to say something like but more often kind of schedule maybe.
CDTG, SPCH, SPAL.
There's actually people with a number 2 pencil drawing a dot on a piece of graph paper. I mean, it's almost
IPST.
ridiculous when you think about it. But you do it.
To get any little bit of
CDTG.
any color is helpful, even though we know that it has been grossly.
AIXC halted down.
Right, they anticipated something like
CDTG,
90 basis points in rate hike for
SPAL.
2022. History. So it can be wildly inaccurate, but it still gave us confidence to what they were thinking at that moment.
Yeah, but I think even if they have less today, I think it'll still end up making its way. It may not be with appearances on CNBC and Bloomberg and then we're out, but I think it'll get out. Anyway, look, we're gonna run out of time because we've already been here for half an hour. Tell me real quick, at the second half of the year, I don't know if you have a year-end target or not. I have this 75, 76 range on the S&P. What's that? I think we're gonna get a pullback and then a rally at the end of the year.
SPCH,
98,000, which I think are fairly aggressive.
SPCU,
I don't look to put a number on it. I think trying to fit where the market's going to be on an exact day is just too difficult. I do think, and I was amazed today because talking to this morning, there was another risk on day, and all of a sudden, back and everything,
Yeah, by the way, did something happen?
I don't really know. Oil is still down. It makes sense.
Okay, what time is it? Coming into the 12 o'clock hour.
CDTG,
Okay, so short dated call flies. Just check this part out right here. For Friday, I would say we got VIX expiration tomorrow. It is Tuesday, August the 18th. Not a whole lot going on today.
CDTG, SPCH, LOFF, SPAX, SPCU, SPCF.
August 18th, right? Yep. What do we have today? August 18th. We had pending home sales at 10. Okay, we got no news really the rest of the day. So S&P, looking for this to move back up potentially.
It's not one that is one of my favorites, I'll say, but it had to take another look. Not sure how ESP balance, but.
Well, I can't comment on anything, but I didn't answer your question about the S&P 500. First of all, I think we're going to see a lot of rotation. I think that we're going to see wild swings like the ones we saw with IBM again and again now, because so much is changing. The ground is shifting under us.
All right, what are you doing? Netflix hanging out. Okay. Tesla turning back up. If you're paying attention, Tesla, there was some big trades on Tesla this morning. Call side. There goes Tesla. Speaking of Tesla, I need to put together what do you call it? Discord. Don't have alerts on Discord. All right, this time of day is good time to be listening for alerts, pulse alerts. Okay, pulse alerts, 0-day S&P.
Micron pulse.
Micron pulse. Micron coming off the low. I have SOXL. Have XOXL. Looking for that to bounce.
Google Pulse. Long dated. Shenanigans. Zero DTE Pulse. Size. Zero DTE. Call side. Size. Q's pulse, long dated.
CAST.
Intel pulse, long dated.
CAST.
0 DTE.
New York Fang stocks are looking a lot better. New York Fang buyers are stepping up.
DTE pulse. Size.
Amazon, Amazon pulling back to the 20-day moving average, looking for a bounce.
Zero DTE. Call strip. Size.
Tesla looking better. It's back above its 20 EMA on a 60-minute. Tesla, Amazon turning back up. Amazon turning back up.
Zero DTE pulse. Size. Zero DTE. Call strip. Size. 0 DTE, call stream. Size. Zero DTE, call side. Size. Zero DTE, call stream. Size.
ND.
Zero DTE, call stream. Size.
Microsoft turning.
NBIC.
Microsoft
Spider pulse.
looking like it might bounce. Microsoft, it's a flat VWAP, so there's not a whole lot of energy here. Nice push back up to the top of the range.
Long dated. Deep calls. SPX pulse. Long dated. Deep calls. SPX pulse. Long dated. Deep calls.
BETA. NBIC.
Micron pulse. Long dated. Avgo pulse. Long dated. Deep calls.
IBM, Amazon breaking higher. Amgen, rather. I'm sorry. Amgen breaking higher. 60-minute 20 MA is trending. This is a good one. Let's see what, if anything, Amgen, new products, etc. Innovative oncology, rare diseases, cardiometabolic conditions. Secured key approvals from Europe. Who in these? Who's these? Who comes up with these names? Oopa Loopa. How the hell do you remember all these stupid names? Amazing. Anyway, Amgen looking good, trending on the 20-minute, the 60-minute 20 EMA. Sorry.
GOOG, not the L kind. Shenanigans. GOOG, not the L kind. Shenanigans.
Google. Seeing some shenanigans down here at the low. Bouncing.
0 DTE put.
Apple turning back up. Apple. All right, Apple worth a shot for a second trade. Apple.
Micron pulse. Long dated.
Apple.
Deep calls.
Been looking at the
Micron
September
long
September
dated.
monthlies.
Deep calls.
Apple.
Meta pulse. Long dated. Deep puts. Micron
That's
pulse.
August.
Long
September.
dated. Deep calls.
Apple. Apple looking good. Apple bought some 315s, sold the 320 for a spread, 315, 320. All right. Those are going for, survey says, those went for $1.95, $1.95, $1.95 filled, 95 cents up. Apple looking for a follow through. Apple. Okay, this could pull back a little bit here, so might have a better entry, a little closer to VWAP. Looking for a follow through.
SPX pulse. Long dated. SPX pulse. Long dated.
And obviously, DR Horton focuses on over the last 12 months at the end of their fiscal in the June of this year is 362,000, right?
0
So
DTE.
the problem
Call
is
sign.
they continue,
Sign.
they're giving all the incentives away, which are cutting into their margins. That's why the stock's only up 2%. It's
Long
a hard
dated.
trade. I'm going to hang on to this, but it's definitely in remove mode for us.
Netflix looking okay.
Be okay with because they're able to focus on their margins. They're smart enough to know when housing starts for single family homes are at the lowest level since 2022 and mortgage rates are rising. There's no new construction that's happening. Right? They're going to focus on protecting margins. They know that their construction costs are rising. So that's awful for home buyers in this country. We are in a housing recession. We're doing nothing to resolve it. We're moving into a midterm election.
Okay, the catalyst for Apple is their flip phone looking to make more money.
management is gonna be, and that's gonna protect your margin.
And I think that's a hard stock to own, based on what you just said. I don't think you're gonna see these stocks re-rate. I don't think you're gonna see estimates go higher. In fact, they could actually go lower. And I just think that that's not a good recipe for action in the stock. And that's opportunity.
Toll has sort of benefited from as you guys already said, the K-shaped economy, right? The luxury home builder is going to do better. It's up 9%. That stock is over the last 12 months, whereas a Lennar is down 34%. And some of the other names, KB, for example, is down more than 12. Nothing else in that space has really done anything other than Toll.
We have Pulte in the ETF. The momentum has now flattened out. It's basically unchanged to your point over a 12-month period. So it is a difficult environment, but you can make the argument that unchanged over a 12-month period in a housing recession is actually relative outperformance to some degree.
Right, but there's opportunity costs in terms of owning these stocks, but I'd rather put my money elsewhere where I can have a better return.
Financials, maybe you want to put your money there because they've been on quite a run. And if you're going to have a more pronounced bear steepening in the curve, then obviously you're going to look at financials as a place that could benefit from that. You've come off 11 straight weeks of gains for that space. It's the longest ever. We hit a record high last week. That's where a lot of the activity, Bryn, has been within the financial universe. And now people like it, I think, a little bit more because, as Steph said, the economy is still good.
Okay, Apple pulling back a little bit. Watch your stops, Apple.
Right, because you can have the short end that you're lending. You have that huge delta between the short and the long end, which is great for banks. I also think you need to think, what type of bank are you buying? So we're Goldman. People are buying Goldman, I think, for trading and IPOs. Bank of America is like the consumer. JP Morgan is like all together. And so I do think that if we were going to keep this steep yield curve, I think you could actually get that baked into earnings over the next few quarters. But I still think there's going to be a lot of volatility. And I still go back to my original commentary about looking at the 10-year over the past 3 years. We've been incredibly range bound. It's been very volatile. And so I think ultimately if rates come back down, then this trade per se doesn't have that much legs, I'll say, from the trade. Long term, though, the financials have been a great asset class to them.
Yeah, look, Bank of America, Steph, up 26% 3 months, a record high yesterday. State Street, Joe, record high yesterday. M&T Bank, record high. Schwab hit a record high. You've got JP Morgan's up 20% in 3 months.
Yeah, but I'm overweight banks, and I also own Capital One too, which I think is the best bargain out there at this moment in time. But Bank of America, they really had such a great quarter. I mean, I haven't seen 15% revenue growth, ROTCE 17%, operating leverage 660 basis points. They win from net interest income, but they also win from fees, and that's what we've all been talking about. And fees. Investment banking fees were up 50% last quarter for Bank of America alone. And M&A is on track to do $4 trillion this year. So far, year to date, $2.8 trillion, up 44% year over year. That's amazing for all of the things.
Let's see the trajectory and the duration of this momentum rotation. The money's
Goldman are within the momentum.
yes,
The IGTMs.
absolutely they are.
Uh-huh.
JP Morgan is in, Joe T, and Goldman Sachs.
Zero
Personally,
GT.
they are clearly financial momentum stocks. You're seeing the rotation. Money Center Bank, we're going out of those today. We're going where there's actually been some relative underperformance the last few months, which is the insurance companies. First thing that always comes to mind for me on a day like today in the market is I want to own the exchanges. I want to look at your CME. I want to look at your ICE. I want to look at your NASDAQ. This is the type of day that's very good for
But you're
your
talking
business.
like an extremely tactical move,
Right? You don't have any more information on the market, Scott, than really the last 24 hours of price action. That's where you've seen the paradigm shift in the way that the macro funds
GOOG.
accepting risks, in the way that the
Shenanigans.
algorithms are allocating. I think the good thing about what we're seeing is that it's a basket rotation.
Zero
and not just a
DT.
flush completely to the exit door.
Stop.
Let's see where it goes from here. It's 20.
Amazon, Google, both pushing higher. So
Jonathan Krinsky.
the New York FANG components are catching a bid. NVIDIA finally turning a little bit. S&P is moving higher. S&P.
Fred Chin, again, he's a technician, and combined with all of the other warning signs, it's not the spot to chase. It in fact looks like a timely area to reduce risk. Think about that. Is the timely area to reduce risk after, again, we'll remind you again, 11
Apple.
straight weeks up, longest ever for this group.
So I don't think so. I mean, the way I played it in our portfolios, obviously, I'm in the investment banking. Goldman Sachs is the primary name that we hold. To Steph's point, I mean, investment banking, 50% right for Bank of America, 55% for Goldman Sachs, right? M&A, capital markets, activity, trading, all of those are distinct positives that that are continuing to accelerate, not decelerating. So the way we play it, I continue to like where we are. I see the run that has happened, but I think it's more of the breadth story that I think will continue to give legs.
Private equity is where I agree with them. Private equity has had a nice recovery rally because software has too. Exactly. Yep. I'll take the other side of that rally. I'll agree with Jonathan that if you're looking at financials, you want to say, okay, enough is enough. I think it's a private equity. I know we asked, like, at the very top of the program, are backing up yields, rising rates a problem for the market, or at some point will they be? It's not showing up in surveys from fund managers. I cited the B of A one earlier as part of theirs today. They just had the third most bullish survey ever. So actually since 22, I'm sorry. The third most bullish survey of investor sentiment since 22. All right, so a number of years, but you get my point. Cash levels are down to a low 3.5%. Global equity allocation surges to its highest level since November of 21. You know what the targets are doing on the street, Brent. Yardeni goes to 8,400 this week. You've got, including him, 9 targets that are with a floor of 8,000. There was a note yesterday that you could do 9,000 in the next 12 months. So people are pretty bullish, despite whatever question marks you have about yields, growth, and whatever else.
Right, because if you go back to earnings, which in the short term are a horrible indicator of like how long you have. Long term, they're a very good indicator. But earnings, take out the Anthropic gains, take out the SpaceX gains of the hype of Google, et cetera. Earnings are still incredibly strong across the market, not just with 10 names. And so I think as long as earnings growth, profit margins, operating margins are going higher. So when you just like take a step back, the economy is doing well also. I'll say less from the consumer, more from all of the data center spending, which is just massive. And so I think you just have to anchor on those key fundamentals and not get too whipped up about where rates are the past week. Let them settle out, because as long as
Tomorrow we got FOMC minutes, of course, and Thursday consumer confidence for August. Personal spending on Wednesday. Looking forward to those.
We will definitely touch this landmark meta trial that's taking place in California, what some are calling the most consequential case yet over child safety issues on that company's platforms. The damages, if the states that are suing win, you won't believe the number.
Zero DTE. Call stop.
Okay, Apple, we got the 310 calls that expire tomorrow. About 9 times normal volume versus open interest. 312.50s for tomorrow. 307.50s for tomorrow. 315 calls for tomorrow, and 305 calls. So from 305 up to 315. Call leaning. Okay, that looks good. Aggressive new bullish bets or hedges rolling into the upside. Overall, Apple open interest remains call skewed, and near-term flow has been call heavy. So we're looking for Apple to continue.
Long date.
Apple.
Zero DTE. Sun. Zero DTE. Call sign. Sun.
PIND.
My contest. Long date.
Has been down today as this trial gets underway in California. Some, as I said, calling it the most consequential one yet over child safety issues on that company's platform. 29 states are seeking damages, which could hit a whopping $1.4 trillion. So as you know, they already lost 2 pivotal cases this year.
Apple looking for more upside.
There's going to be a lot of attention on this landmark case. Nobody owns it currently here. Steph, though, I come to you. You sold it recently.
Zero
Just
DTE.
yet another
Call
thing for
sign.
people who own this name to be concerned about.
Yeah, I mean, you're right. One more thing. I mean, I sold it because of fundamentals. I sold it because they're spending like drunken sailors, and I just don't know when they're ever going to see operating profits. I mean, I really don't like the leverage.
Yeah.
Those profits.
And this has issues potentially with the algorithm.
Okay, S&P pulling back a little bit.
Whether you believe it's going to turn out in the the worst case scenario or even close, it is an overhang.
It's definitely an overhang, and I think it's not going to go away anytime soon. And so you have this overhang. You have them spending crazy. You don't get the margin growth at the same time. It's not expensive. It's a 16 times forward estimate, I think, for a reason. And so I suspect they're going to settle on this, and we'll find out in months from now, maybe even years. Who even knows, right? So I don't know. Just for me, I think that there were other places I wanted to put my money. I actually put the money back into Amazon.
I wanted to come to you on SpaceX also because you have the next lockup expiration this week on Thursday. As many as 319 million shares, or 7% of the total amount. How do you think about that? Because you've been adding to that name.
And I'll continue to add to it.
Even with these lockups and these stair-step lockups, you're undeterred by that.
Because I'm taking a very long-term view on it, and I'm averaging down in my cost basis, unfortunately. The stock's down 28% from its high, Scott. So, I mean, I will continue to add. It's actually rallied nicely in the last week or so.
It has. It's back above. Remember, it got below the 135
The IPO price.
the IPO price.
Yeah.
And now it's back.
And I really thought the quarter was great. We talked about this when I added to it last week. I mean, you total revenue of 91% and EBITDA up 191%. And, they're doubling their subscriber base. And, the space business, they have such a huge advantage on cost and first mover advantage. I think there's a lot of ways to win. And of course, the renting of AI, that's really, the compute is really something very powerful.
It is a long game. You're not buying this for this past quarter, the next quarter, or the one, or the one, or the one, or the one after that.
Like when I retire.
But look, given what you said about Meta and the spending, SpaceX is a hyperscaler.
Yes.
Okay.
No question.
There's no question about that.
No question.
They're going to be spending, and you're going to be okay with that.
And they increased spending in their AI division by 65%, but they said the payback period would be in 1 year. And so that, at least, I'm willing to hang my hat on in terms of believing what they're going to say. They're going to continue to spend. They may even have to do another secondary for all I know. I just think this management team has it. There's many ways to win. And like I said, call me when I'm 65.
All right, software.
Okay, Apple's not following through yet.
Snowflake goes to 408 from 325. outperform at Citizens. I'll give you this one. Steph owns it too, but let's hear from you.
Yeah, so I mean, Snowflake's been phenomenal. It's up 47% so far year to date. EPS revenue, revenue was up 33%. EPS were up 68%. I like the deal that they just did with AWS. I think the consumption model is interesting because it can produce inconsistent results, but I continue to like this data warehouse storage game. I like this name in the software. So
Okay, then I'll go to Steph because you and Steph both own ServiceNow.
Yeah.
What do you think about this one as the target goes to 150, overweight at Capital One?
And it's had a nice rally off the lows, but it's still down 22%. I still can't get my arms around this.
Okay.
24%.
I closed Apple. It's not going anywhere. I'm looking for momentum like this morning. I closed it flat, didn't make any money, just sat here for a few minutes looking for a breakout.
Which is also very important. I think that's only going to increase and that will help over time to earnings and
Zero DTE.
Cyber's been great.
Stop.
Everybody knows that. CrowdStrike, Joe, 250 from 235 benchmark.
Yeah, let's get a little bit more of a correction here in front of earnings. I think that would be healthy. I would like that. CrowdStrike, I believe, reports the middle of next week.
Okay, it could go. It could go. That's fine. I'll jump back in if it starts to move.
Expectations to this earnings report. See a little bit of an adjustment in price, maybe for CrowdStrike below 200, back towards that 190 area.
Let's do Brent on Uber. Outperform 112. Mizuho, you own that name still, right?
I do. I've been in and out of this name. I think I've traded it pretty decently. You've been able to buy this name in the high 60s, low 70s. And then right now we're at resistance. If it can break above this 76, 77, I think the stock can just easily drift into the mid 80s where I'll probably sell and do this again. But I think at this point, the fundamentals are there.
Apple
It needs to get above this 76, 77.
probably sees me.
Back down into that low 70 price range.
Okay. Brent Collins, he has a
This time of day, generally don't see a lot of momentum anyway.
Two explosions toward an industrial recycling plant in Toledo, Ohio, earlier this morning. Officials say a few others suffered minor injuries. The blast erupted during a shift change at Brett Industries. Firefighters are now battling the flames, hazardous chemicals, and contaminated.
Okay, that's Apple. Let's see. Adobe, Monster. DoorDash was looking good this morning. That kind of faded from the high, right? Okay. Netflix. All right. So we talked about 12 o'clock. I'll start looking at investing strategies at 12 o'clock. So while we're waiting on Netflix, it's at the highs. Let's do that. Okay. So if you're an investor, number one, and if you have a 401k at work, number one, check with HR, find out what the company match is. Almost all companies match a certain percentage of your investment. So if you invest $1, they might invest 25 cents or 50 cents. If you're lucky, you might find a company, Fortune 500, that'll match dollar for dollar. So you put in 1,000, they match it with 1,000. That's free money right there, right off the bat. So number one, check with your HR rep, find out what your company match is. Okay. And then let's take a look at a few things. So if you're just starting a 401k, what I would suggest, this is a benchmark. Okay. T. Rowe Price is the benchmark I've been using for 40 years, 38 years. And similar products. Now, T. Rowe Price hasn't been around that long. This particular hasn't been around as long. If I go back 25 years, I think this is fairly new. Let's see, 50 years. All right. So this started, I started investing in 87. This one started in like 94, 95, back when we had our previous secular bull run from 1987 into the year 2000. We had a 13-year run. Okay, we had a 13-year run there. We're currently, if we look at the S&P, let me see, longer term. Let me go to S&P. We had that 13-year run. So TRBCX, this has been on my radar for 30 years. Okay, let's see. Should be right here. Let's see, monthly, yearly. No, I want to go here. Okay. All right. So the 1987 run up. Okay, so there was a period in here where we actually had a 33% correction. So starting at 1987, which is when I started investing, okay, you had that 13-year run up into 2000. So if you use the entire period between consolidations, that's 20 years. Okay, we're currently on year 14. Okay. And from when I started investing, the markets are up considerable in that time span. Okay. So 2,700%, 2,700% earnings. Now, if you just deposit $100 a week, I forget the exact numbers, but you deposit $100 a week from your late 20s to the time you're ready to retire, you're going to have over several $1 million, $7 million sitting there as a nest egg. If you just put in like $100 a week, $200 a week, whatever you can afford to do, $200 a week, obviously even better, but just have it automatically taken out of your paycheck, you know, $500 a month, that's good too. $500 a month. Invested in an index fund. In most companies, you can trade or you can invest in something like the T. Rowe Price Blue Chip Growth Fund. I just wanted to show you. We're on year 14 right now out of this current base. So can we get another 2 to 3 years of Trump's term? 2000 into 2028? Probably. So if you're going to do that, let's take a look at TRBCX. All right. So TRBCX, you want to invest, you want to buy into this in tranches. You don't want to do everything. You don't want to throw everything into it. What's going on here? TRBCX. TRBCX. So we invest in TRBCX.
Shenanigans.
Currently in TRBCX. Okay, since 2022, the end of the last bear market, we're still in an uptrend. You want to pay attention when prices are above the 10 EMA on a weekly time frame. You want to be adding when it's above the 10 EMA, and you want to start to reduce your exposure a little bit if we start to lose the 10 EMA on the weekly. That's pretty straightforward. So right now you're in a mode where you want to start adding into TRBCX, or you could use RGAFX. Okay. If you can afford $100 a week, 200 every 2 weeks, the more you can afford to put in, the better, because you're going to get company match anyway, which is going to make it easier for you to reach the goal when you finally retire of having $4, 5, $10 million in your account. If you add, you can do the math, compounded monthly, what that can turn into. All right, you can just have Grok or Gemini do it for you. We can do it right here. All right, so let's do it right now. Okay, let's go to AI mode. Okay, so using a company 401k where the company matches, let's just use a low number, matches 25% of my contributions and working for 25 years. Let's not do 25 years. Show me the yearly gains if I contribute $500 a month versus, let's see, let's do 400 a month. That's $100 a week, 400 a month. That's good. Okay. Some of you actuaries like Corey could probably do this in your head. Using a company 401k where the company matches 25% of my contributions. Show me the yearly gains if I contribute $400 a month. Consistently. 1 year, 2 years, 5 years, 10 years, 20 years, and let's see, you're 30, so 30 years, okay? Let's do 30 years. $400 a month consistently, 1 year, 2 years, 5 years, 10 years, 20. Okay. Now, I will invest in TRBCX as my primary fund. Okay, let's see what it says. Let's see what it comes back with. Okay. Using a company 401k where the company matches 25% of my contributions. Show me the yearly gains if I contribute $400 a month consistently, 1 year, 2 years, 5 years, 10 years, 20 years, 30 years. I will invest TRBCX as my primary fund. Okay. Total employee contributions, 24,000. Employer match is 6,000. Okay, so net investments, net total ending total balance $1,139,000. 30 years from now. Now you might be saying, "Yeah, Vinny, I want to have fun. I want to spend all my money." Blah 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 blah. More power to you. But if you get to 50 years old and you haven't contributed anything in your lifetime, it's going to be much harder for you to make substantial progress financially. All right. So let's run the same thing. 401k balance. Okay. Let's run the same analysis with 500 per month contribution and a company match of 50% up to 5,000. Most companies will do 5,000, I believe, up to 5,000 per year. Okay, let's see what that comes up with. You can't depend on the government to take care of you. You got to do this yourself. If they did this with the Social Security funds, people retiring now on Social Security would be so much better off. Okay, so just contributing another $100 per month with a 50% match, you're talking net gains of $1.4 million. Okay. Now you can do the same thing yourself. I would just use TRBCX as a reference model. If you're going to, the more you can afford, the more the company matches, the better off you're going to be. Just run the same analysis. You can take a snapshot of this, run the same analysis with what you plan to do and see what the end number is. And just let it go. Let it go automatically. All right. Up to 2.64 million at the fund's historical 12% average. Okay, so I can't tell you enough. This is how you should look at your future. Everything might be rosy right now at 25, 26. You're coming out of college. You got a nice new job. You know, you got a new girlfriend, a boyfriend, or whatever. This is one way to support yourself and to contribute over the years. I highly recommend it. I'm not a FINRA registered advisor, but this is what I did over the years that I've been, I worked as a corporate employee, and it's made my life a lot easier. Okay, here's Netflix still sitting at the highs. Now that's just saving in a company 401k. Now, let's say that you listen to the broadcast and every so often you're selling credit spreads. You know, over a lifetime, you make, if you can average $500 a month or $500 a day, or even $250 a day, that's $2,500 a month. Okay. So if you can take that $2,500 a month and also build up your account, you'll be looking at $3, $4, $5 million down the road. Just using common sense with your investing and increasing your probabilities of success with credit spreads. You know, if you're selling 20%, if you're selling 20 deltas, you're giving yourself about an 80% probability of success. So not everything is going to work out. Anybody who's been here more than a year knows that Microsoft was a bite. That took a bite out of our buttocks. Microsoft was a bad trade a while back, but you make up for it. You know, approximately 75% win-loss rate on credit spreads and iron condors, just as a basis for making you, giving yourself a better future. Okay, so Netflix still watching here. I realize I keep flipping back and forth between day trade mode and long-term investing mode. But every lunchtime, I'm going to start doing this. I'm going to start covering some aspects of investing, not just about day trading in the first half of the day. We'll focus 15, 20 minutes to half an hour on investing, you know, what funds you should be thinking about. One of the other things you might consider is as you get a little bit older, start investing in funds that pay dividends, right? I have a list of ETFs here. Okay. And let's see here. Summary, edit. Okay, so here are the ETFs that I've been focused on over the years. I keep collecting them. Some I'll get rid of if they don't perform. High dividend yield financial. Okay. KBWD, that's pretty much in a range, so I would pass on that for now. SPHD, this is one I've been in since 2014. What I do is it pays a monthly dividend, so I have the dividends roll back into shares. I recommend that in the first 20 years or so of your investing career. Take the money from dividends. You don't need it until after you start to retire. The dividends you can start collecting after you retire. You can put all this in a Roth IRA as well. If you don't have a 401k company, maybe they have a Roth IRA, some sort of investment strategy. at your company. Look at SPHD. This is a very good fund. You can see it's been trending all of this year. If you bought back in the beginning of the year, you'd be up. You'd be up for the year 15%, 14%. Okay. And you're reinvesting your dividends. The dividends come in, you just buy more shares. So you'd be up like 20% for the year. 20%, that's better than most years for the S&P 500. So use compounding interest, take 20% or even 15% year over year for 30 years, compounded interest. You can see how this could add up to a substantial sum, okay? Rolling your dividend back into buying more shares. You can select that in your fund. There should be a toggle somewhere that says reinvest. That's SPHD. SCHD is another one that I use. Trending. If you look at the weekly time frame, you can see what it's done this year, what it's done for the last 5 years. Okay, what it's done for the year, it's up 27%, 28% on the year. So you've beat the S&P 500 already, and it's not even August. Now, I've recommended this particular ETF for years now. I've been talking about it a lot for the last 18 months. So if you've been into it for the last 18 months, a move from about 24 or so up to the current price, 34, right? 30%, 32% or so. Compounded, however it's compounded monthly because you're getting a dividend and rolling it back into shares. That's how you become wealthy, generational wealthy, make your kids much better off, prepare for their college education. You can do this. You don't have to do it in one account. You can do it on several accounts. You could do it for each kid and just have a monthly contribution. Put it into a Roth IRA or into a Coverdell is what the kids have, a Coverdell account, or a 529, I think is one of the other ones. Okay, so I'm going to do this every lunchtime if I can. If there's reason to do it, I won't repeat myself daily, but I might do it by, 2 or 3 times a week. There goes Amazon. Pointed out Amazon a little while ago that pay attention to it because it might bounce here at the 21-day. Looks pretty good here, Amazon. What do I have in Amazon? Amazon. I don't have a position in Amazon. Amazon earnings. Okay, it drifted back from as the earnings. So this is actually a good trade here, Amazon. Maybe taking a 40 delta, which is a 270 for September. Can we get to 270? We can get to 270 by September. Buy a vertical, maybe. Vertical. 270, 275. That's $160 per contract. I'll buy a couple of these. I'll add to it if we continue. Amazon breaking out. I bought the September 18th, 270, 275 call spread for under $2 a spread. Let's see exactly what my fill was. $1.60. $1.60 per spread. And the payout was for each contract, the payout $75 makes you about $180. About $180. All right, so that's pretty good. Better than 2 for 1, and you got time. Now you could go out to October as well if you want to go out and give yourself a little bit more time. It just reported earnings. Surprise. Okay. They reported $5.75. Estimate was for $1.82. So they blew it out. I believe Frano and Brother Bill were in this for earnings, the gap up. They might have taken some profits off in that gap up. But you had the gap up, the fade. So if you liked Amazon prior to earnings, you probably like it even better right now on the dip if you took profits into that gap up, pullback. Now it's sitting on the 21 day. If for some reason we lose the 21 day, that would be a stop.
Long dated.
CDTG.
Lowe's has earnings tomorrow. I'll probably do an iron condor on Lowe's. Let me show you what I'm looking at on Lowe's. Where are you? Lowe's. Lowe's. Okay, Lowe's.
0 DTE. Call side. Side.
CDTG. BBM halted to the upside.
Okay, it's about a 25% return on investment. Okay, so I'll show you what I'm looking at on Lowe's for tomorrow. I'll look at it again tomorrow.
CDTG. NBIZ. AFLX.
Okay, let's see here. We got return on investment.
CDTG.
CRWB. Long dated. Shenanigans.
AFLX. NBIZ.
User. Give us the details. We know where that's going. Eli Lilly. Yes, sir. Josie Lilly about to leave you.
Eli Lilly, Netflix. Okay, who? Okay, I think the black dude. I think forget his name. He's a good investor though. Portfolio manager. Recommending Netflix. Netflix on the move some more.
NBIZ. CDTG. AFLX.
All right, so at 31%, about a 31% return on investment. Yeah, last 3 years have been like 20 plus.
CMD.
Mm-hmm.
0 DTE. Call side. Side.
Yeah, I think it's been like over 20%, Corey, for the last 3 years. Let's see what Santelli has to say here. Good observations, Rick Santelli. Got to pay attention to this guy. All right, U.S. Treasury, it's only down 10 basis points, not much, 4.71%.
Our July 31st high yield close of the 10-year, which was 473.5. Touch 474.5, but we're back down. But should we get above there on the close, be the highest yield close since January 25. And by the way, what's our debt to GDP? 125%. Here's Japan. Okay, 30 years. You pointed it out. Yes, we haven't seen these mid 290 yields in 30 years. What's their debt to GDP? 220%. Look at France, 411. 18 years before we've seen that. Debt to GDP in France, 120%. And finally, Germany, 3.25, highest in 15 years. Their debt to GDP, half of some of our countries, 65%. So you can see that is a debt issue. But if this was the kind of route that everybody seems to want to point to here, these yields would be much significantly higher. They'd be 7, 8, 9%. Now, I'm not making light of this, and I still think there is a backside that could be a bit nasty, but short-lived. But ultimately, it's still orderly. The only thing you want to really pay attention to that could make it a less orderly is some of the big positions, for example, in the U.S. with the repo market, reverse repo market, and the way the Fed conducts business now. There is a huge amount of open interest holding treasuries. So we want to make sure we watch that if there's any mock nails on that tinderbox that we will recognize it. But at this point, it's world the best for sure, but it's still not a good test.
Well, we are about to speak to someone who thinks those Japanese yields should actually be more like 10% or even higher. Rick, thank you, Rick Santelli. Our next guest has been warning that Japan is in a debt crisis and says the rest of the G10 doesn't look nearly as alarming yet. But the longer this goes on, the more it does raise.
Okay, Apple turning back up for those of you keeping an eye on Apple.
This is like the summer
I took it off. It looked like it was going to slow down, no momentum. It, in fact, is still looking pretty slow.
I don't think people understand how much central bank activity is holding down bond yields in Japan and in Europe. How much would you say they are doing so?
Hey, Kelly, it's great to be with you. And, you know, your intro is perfect, right? When you and I last spoke, we were talking about shadow yields, the idea that central banks are so important at managing yields. And, of course, the Bank of Japan in Japan is holding yields down artificially. It's very significantly.
Netflix.
The 30-year yield that Rick was talking about just now, that's around 4%. I think it'd be in the double digits if it weren't for the Bank of Japan. So it's true what Rick says. We're not at crisis level.
Tesla.
But you have to factor in that.
Okay, we're looking for some activity from the institutions. That probably won't show up for another hour or so. I usually look for institutional activity after 2 o'clock. All the chips have down for the most part. Chips are down.
It's not treated well. And I guess you would argue that's a little bit of what's happening there. So how much longer can Japan's central bank suppress bond yields? And to what extent is this happening in Europe as well? And do you feel that the US is a little bit of a different story?
So Kelly, you're totally right. Japan is between a rock and a hard place because obviously if the Bank of Japan moves to bring long-term yields back down, then as you said, that's going to augment appreciation pressure on the yen. So they're kind of damned if they do and damned if they don't. And the only solution, the only way to stop shuffling the deck chairs on the Titanic is to actually do something about the underlying problem, which is too much debt. And Japan has the means to do that. They are an incredibly sophisticated country. The government has a ton of financial assets that it can sell. And it can sell those to basically buy back debt and bring its debt down, which, as Rick correctly said, is 220% of GDP. But you know what, Kelly? I think this is a bigger issue. Something about fiscal policy came unmoored during COVID. the decade before
Here's
COVID,
what-
we all ran around telling
date.
ourselves that interest rates and inflation would be low forever. And if you look at the US deficit or debt issuance now, it's running around 7% of GDP. It's completely bonkers. So there's a stock problem and there's a flow problem, and we are struggling on both fronts.
So how does this play out? Because there are plenty who would say this level itself is not that alarming. Just look at the stock market. Even in Japan, look how high the stock market is. In Europe, look how high the stock market is.
So the way markets are trading all of this, the countries that are getting hit hardest are the ones where debt is high and we have a lot of political dysfunction. So you basically have governments with weak mandates that are about to face elections. So the countries that are getting hit the hardest are Japan, France, the UK, Italy. All these governments are basically struggling to hold things together. And there are basically two ways that this can go. One, and this is probably the way things will go, and it is an unhealthy way for things to go, is governments will say, hey, we have dysfunction in bond markets. Markets are dysfunctional. We have bond market vigilantes. We need central banks to intervene to bring things back down to normal levels. That's just going to make that's basically kicking the can down the road. It'll just punt the problem to tomorrow. And ultimately, it is younger generations, future taxpayers that are going to bear the burden for this. The much better way out that I unfortunately doubt it'll be taken is for governments to be proactive. I gave the example of Japan's government, for example, saying, you know what, we're going to sell, say, 5% of GDP of our financial assets and retire some of the debt that we hold. Markets would love that. It would be a huge positive signal, but it won't happen.
How would that work? When you say that, is only Japan in that kind of position where they have these holdings that could be sold? And I can understand the public feeling nervous about that. It feels like you're selling the crown jewels, right? Does the U.S. similarly have assets that it could sell, or does Germany or France or Italy, or what kinds of assets do they have that they could sell if they needed to pay down debt?
So governments all around the world have assets, and of course, governments also have government-owned businesses, right? Sort of the post office, that kind of thing. All these things, in principle, you can privatize, and you can use the proceeds to pay down debt. But the obvious examples are Japan, where gross debt, as Rick said, is around 220% of GDP, but net debt, so factoring in the assets the government has, are net debt is around 130% of GDP, so a lot lower. And that can be everything from financial assets, so checking accounts, cash, to equities and so forth. Another great example is Italy, where the central bank famously holds lots of gold. It could sell that gold since gold prices are way above where that gold is marked on the central bank's books. And the gains from that could be used to pay down debt that the government owes. In all these cases, it doesn't happen because there's basically vested interests that like the status quo. And so we're stuck.
You know, when you lay it out that way, I think I'm even more alarmed, frankly.
Yes.
And I understand why we're probably going to muddle through with some kind of quiet central bank papering over, shall we say, of the issues, unless we can really figure things out. Robin, really appreciate it. Let's check back in soon. Actually, I hope we don't, because things get better. But, if not, thank you for making the time. Robin Brooks joining us for Brookings today. Let's see what our next guest thinks about all of this. The U.S. has seen higher yields before, but not when our debt level has been at these levels. We had $40 trillion on the national debt over weekend. Yields on these levels are costing us more than $1 trillion a year just in interest payments. It's the second highest government expense. We've spent more on interest so far this fiscal year than we have on Medicare or on national defense. Sam Stovall is the Chief Investment Strategist at CFRA. You're going to calm us all down, Sam, right?
Absolutely, Kelly. Good to talk to you again.
Good to see you. How would you come at this problem? Is it a problem?
Well, I think it is a problem.
Micron, still no follow through.
Some time. You look to the most recent GDP data, and it comes in weaker than expected. You see the employment picture, you see the retail sales, and you wonder whether debt is playing a big role in that. I like to harken back to the old adage that the consumer stops spending only when the banks stop lending. And the banks right now, with a nice improving yield curve, are very happy to continue lending.
we've actually seen, and we were talking about this a few times in the last recent weeks, decent amount of liquidity in the system. A reason why some think the Fed might want to lean against that. But this is a complicated scenario. We have high deficits, but yet we have kind of a lot of strong demand in the real economy. So like you said, banks are lending. So is all of that just kind of extra firepower for the economy and for the stock market, even if it's creating a little bit of a problem, down the road?
Okay, Amazon still pushing a bit more. Amazon. Amazon. I like Amazon off of the 21 day. Amazon.
Yield curve, the reinversion of the yield curve, the Somme rule, etc. Yet the economy continues to chug along. Certainly, higher interest rates possibly are indicating that if the Fed isn't going to raise rates, so the bond market will, out of concern.
All right. So the reason why Amazon faded from highs from the earnings, the reason it faded is because they're looking for 197 billion. Companies looking for 197 billion in the next quarter to 202 billion. This last quarter, they reported 200 billion. So this is a little bit flat. On the low end, it's a little bit less. On the high end, it's a little bit better. So it's somewhere in between the earnings that we just came out of. They beat expectations by 53%. Estimate was for $1.83. They came out at $1.88. 196 billion revenue estimate. They came in at 200 billion. AWS is booming and should continue to boom. This is the biggest part right here.
Yet the market seems to be wanting higher rates. History also indicates that in the last 50 years, 6 out of 6 new Fed chairs, their first move was to raise rates, not lower them. And going back to World War II, 8 of 9 did exactly that. Only Arthur Burns cut rates as his first move. So history would imply that higher rates are likely to be the next move.
All right, we're showing those levels there, 471 or so.
And all right,
Sam, let's get away from all the big, scary, difficult stuff. You do have a couple of stocks CFRA has recently upgraded: Becton Dickinson, Arrow Electronics, and Plains All America Pipeline. I don't know if you just have a kind of final comment about those.
Sure. Well, there are always opportunities in the marketplace, no matter what is the backdrop. Like Becton Dickinson, we like this company because we've been seeing indications of an improvement in the medical device category, and this company is going to be focusing on its med tech portfolio. Arrow Electronics, we've been seeing book-to-bill ratio for this mid-cap tech distributor doing very well, above parity, and we think that its end markets will be supporting the forecasts. And then lastly, Plains All American, fool me once, shame on you, fool me 25 times, shame on me, in terms of when the Straits of Hormuz will be reopened. So I think certainly U.S. crude to export markets is going to remain an industry need, and that's what Plains All American does.
That's a great point. A great place to leave it as well. Sam, thanks so much. Really appreciate it today.
Thanks, Kelly.
Sam Stovall with CFRA. Coming up, the landmark trial between Meta and more than 24 U.S. states. It's kicking off today with potential fines that Meta says could run over $1 trillion. We'll have those details next. Plus, Robinhood is here with the latest trends they're seeing, including this name, which, after sports, is the most popular subject on their predictions platform. And we'll reveal it ahead on The Exchange.
This is The Exchange on CNBC.
All right, Amazon at the highs. I'm just watching Amazon here. Back up to the high of the day. don't think we're going to break out. That probably happens tomorrow, I would think. Okay, we're still up here dealing with the high today. We're at the 21 day. Okay, which is good. 21 day. And that is orange. 21 day.
SPX calls. Long dated.
Okay, good. 21 day and the 200 day. 200 days here. Red. 200 day.
Meta pulse. Dated. Deep calls.
Okay. Swing high is right there. Earnings. Let's see.
Welcome back. Not long after losing a child harm case in New Mexico, where a court has ordered Meta to pay nearly $1 billion in fines, Meta is back in the courtroom for what could be its biggest legal fight yet, this time against 29 states. Opening statements kicking off just a couple of hours ago. Julia Borson is in Los Angeles with the latest. Julia?
Kelly, opening statements kicking off this morning at a federal courthouse in Oakland with the lawyer representing the state suing Meta, Megan O'Neill, saying Meta prioritizes profits over the safety of children and Meta's financial success depends on keeping kids on its apps, saying that it knowingly developed features to take advantage of them. O'Neill says Meta told Congress, users, and parents that its platforms were safe, quote, all while it hid the truth time and time again. Profits won. She alleges Meta built a business out of harvesting kids' data, sending them ads, and selling them things to keep them hooked on their platforms. Now, the 29 states involved in the lawsuit are asking for Meta to pay monetary damages and for changes to its business practices, including the likes of infinite scroll and autoplay videos. Today, we expect to hear Meta's opening argument as well. But ahead of the trial, the company is saying in a statement, quote, the AGs offer no proof anyone in their states was misled. They claim benign features like having an additional Instagram account somehow harmed their residents and attempt to penalize Meta for industry-wide challenges like age verification. Now, outside the courthouse this morning was a gathering of victims' families along with members from a nonprofit called Heat Initiative, which aims to hold tech companies accountable for online child exploitation. Kelly?
A sense, Julia, of how long this could play out? Are we going to get the key players in the witness chairs?
This whole trial is expected to last about 7 weeks, and we do expect to have Mark Zuckerberg as well as Instagram head Adam Mosseri both testify in this case. We're just not sure exactly when yet. Right now, they are on break, and we expect to hear from Meta's attorneys when they return after this short break. But certainly a big day for both Meta and this coalition of state AGs.
One more question. How is this the same or different from the New Mexico trial that wrapped?
This is a lot bigger in its scope. New Mexico was just about the state of New Mexico. Here you have a group of state AGs which are focused on the negative implications for kids. And then you have another group of 29 state AGs that are focused on the privacy implications and privacy violations. So there are so many different issues at play here. And in terms of the impact, the potential implications are much higher. The amount in damages that they're looking for, the states say it's about $200 billion, which is a number many times larger than what they were looking for in New Mexico. And then you also have the potential changes to the algorithm. So much bigger in scope. This is really seen as the key bellwether case that could have implications for how all the other cases that are said to be tried over the coming year or so should play out or could play out.
All right, Julia, really appreciate it. Thanks. So Julia Borston there. Our next guest says this could be Meta's Microsoft antitrust moment. Let's bring in Nilay Patel. He's editor-in-chief at The Verge. Nilay, it's great to see you again. And yeah, I mean, there is a lot here potentially at stake. Just to quickly recap, $1 trillion plus fine for Meta, according to the company. Big changes maybe to their algorithms, an end to the
Blah, 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 blah. Nothing's going to come of it.
Earnings in the coming days, but we'll focus our conversation on the stock that has outperformed a lot of its peers this year, and that's Target, with shares now facing a pretty critical test as momentum has run up relatively significantly into the reports tomorrow morning. So for more on just overall expectations for Target as well as broad retail, we are joined by Nick Raich, CEO of Earnings Scouts. And so Nick, thank you so much for your time today. When you assess Target going into earnings, do you think the bigger story is the quarter itself or what management is going to guide for and all of the expectations now for the back half of this year?
It's all, I mean, we want to know what happened over the last 3 months, but for the relevance of its stock price, it's all about the future and the guidance it's going to provide and the outlook on the consumer and spending across, you know.
Oh, boy.
Certainly.
When you assess this company in particular, in terms of Target, has this been a story of them losing market share to, let's say, Walmart over the last few years, given some of maybe the execution or branding missteps they've had? Or has this been a story more of consumers just looking for lower priced options?
You know, in the case, yes, it did have its struggles initially, but over the past year, the expected profitability for Target, and that's all we really care about, has been on an improving path. So its estimates have been improving, and that's the reason why it's been outperforming. So as long as it can maintain a positive corporate outlook in terms of its earnings and sales, that's all the street cares about.
Okay, so I think Target interesting because it gives investors different windows into spending, especially in areas like discretionary, I mean, apparel, home goods, general merchandise. And so of all of their various sectors, will there be one that stands out to you most closely or that you're watching most closely?
You know, I would say just the consumer in general, because we know rising oil prices and inflation and the potential for higher interest rates in the future. So we're seeing the 10-year yield going up, interest rates going up. Maybe the bond vigilantes are trying to work at the Fed. We know higher interest rates could start to impact the consumer. So that's why the outlook's going to be very interesting to see what Target's going to say in terms of what it's seeing for its order flows.
NVIDIA
and the like. Because in general, I'm just looking at the trend because, yes, the consumer spending would have thought, in my opinion, I would have thought with the rise in oil prices this year, that would have really hurt the consumer. But we've seen the consumer still spending, and we want to certainly see if that's going to be the case.
Target's not alone in the last quarter having a pretty nice earnings growth. Much of the market has shown pretty tremendous growth in the last several quarters. We're on pace for another one this quarter. We're through like over 90% of the S&P 500 now. Nick, when you kind of assess what has been so far in this earnings season as a whole, what stands out?
I think it's been exceptional. The growth is going to be above 25% for the S&P 500. Which, you know, normal growth in any given year is 6 to 8% per quarter. So the fact that we're growing at 25%, it's just been exceptionally strong. And certainly tech standing out, consumers standing out, financials have done very well. And the key is the third quarter estimates. They're still going up collectively after company support. And that supports higher prices. If there's one negative little gray cloud there, what we are noticing this earnings season is that the estimates, while they're still going up after company support, they're not going quite up as much as they were 3 months ago. So rate of change, we're seeing some slowing in the positive estimate revision momentum that we saw. Could be possibly in the first quarter of this year. If that's the case, first warning signs heading into 2027, that rough seas ahead.
Okay, so the theme that you have highlighted is earnings estimate revision momentum, as you just mentioned. So, I mean, across the board, do you still believe that analysts are raising numbers at a pace that supports the momentum, or are we beginning to see more signs of fatigue, say?
It's possible that we're seeing a slowing in the momentum, but still, it's the foot's on the accelerator. It's just letting off the accelerator a little bit, but we're moving forward in terms of the estimates. We're certainly not slamming on the brakes where the estimates are being cut.
but he's still supportive of higher prices. But we're keeping a very close tab on that second derivative change in the estimates that may be signaling ahead that some of the best of the revisions may have peaked.
All right, it's very well. It's kind of a calm before the storm. Let's say we'll get NVIDIA, we'll get Broadcom. I think we got Micron left in the next coming month or so. But this week is sort of retail, big box retail in particular.
Okay, Amazon pulling back from the high.
We have Home Depot, I believe, as well. But we got Walmart on the calendar too. You know, of those, you know, what do you think we'll learn? You know, at the end of this week, what do you think the headline's going to be?
Well, what I'm looking at, there's 43 companies in the S&P 500 that are going to be reporting a July quarter end. And those would be NVIDIA, Walmart, Target. This morning we heard from Home Depot. So what we're going to do is look at the sample size of just those July quarter ends to see is their growth collectively still reaccelerating. So far, we think that will be the case, but we're going to look at the guidance that they provide after to see is it improving to what they guided 3 months prior, 6 months prior.
Okay, Amazon pulling back from the high. Amazon.
So that's going to be the main thing we look at. It's going to be
Doji at the 21-day. Do we hold here or head down to the 50-day?
Okay, so I mean, I think it's interesting. We all make the comparison of like some of these major tech earnings compared to say like retail, and so I mean, just based off of like the broader rotation narrative that markets have tried to spin this year, would you say that still what matters more to the overall market is frankly these tech behemoths or like any read into the memory cycle, for example, with Micron, than say the consumer, which I know that the consumer has been definitely somewhat of a spot to watch as far as broader economic read, but has felt like it's been fairly resilient, and so we do turn our attention to more of these like high volatility names like NVIDIA or Micron.
Yeah, if I had to guess, I would have thought their consumer would already have rolled over by now with just the spike in energy prices. But we're not seeing it in the data whatsoever. But my gut's saying they would be. So that's what we're going to look to see if consumer can remain strong. And the technology, the AI boom, I mean, it is a boom. We are in the roaring sure.
Okay, coming into the 2 o'clock hour, we'll be looking for institutions to show their hand if they're interested or not. We gapping down, so I'm thinking no, they're not they won't be interested. That they'll just let things fade so they can buy again. NVIDIA, watching NVIDIA off the low here. NVIDIA with the gap down. Earnings. Earnings the 26th next week, Wednesday.
Spider, long date. AMD, long date. AMD, long date. They're getting it down.
Oh, she's got your smile, Carl.
They're getting it down.
Number one brokers there, looking a little dependent.
Actually, we invest with Schwab now. We have everything we need all in one place.
I can set up for college fund.
I've been learning about new trading strategies.
Schwab helps me generate type of all the Schwab as everything he is making me wacky.
Somebody made a map. Invest your way with Schwab.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
0 DTE. Pulse. Stop.
Welcome to Schwab Network, where real-time market coverage meets expert strategy. From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and
Long
sharp
day.
trade ideas minute by minute.
With shows built for action, we break it all down in real time. With
Shenanigans.
speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Apple turning back down. We'll look for another opportunity on Apple tomorrow, probably.
Streaming 24/7,
Shenanigans.
any screen, anywhere.
Watching NVIDIA here, trying to go. NVIDIA.
Investing. Now, markets are trying to make sense of some softer data we've gotten as of late, as well as a more resilient consumer and what it all means for the Fed. So now we turn to Jeffrey Klingelhofer, portfolio manager and senior research analyst of securitized assets at Original Funds. Jeffrey, thank you so much for being with us. We have seen some softer data lately, including payrolls, retail sales, and inflation. So how should investors be interpreting those signals? And are they showing signs of the slowing economy or simply moderating after a period of what has been unusually strong consumer spend?
I think what I would say is, I think last time we were speaking is.
What's Core 1M? Core 1M is currently 943, climbing, which is a good thing. Shows that traders are not chasing calls as much as they have been. Calls are still fairly expensive. Implied volatility. Check the implied volatility and IV rank. You want those above 50% if you're thinking about selling premium.
All of this suggests that they're probably more in the anomaly camp, and if nothing else, the consumer backdrop remains resilient. But there are pressures; those pressures are mounting, and I think what we're seeing is the consumer just simply paring back. So taking some of that over exuberance that was potentially on the table, and
Hedge flows just kind of sitting here doing nothing. 0 day, lots of resistance overhead.
Spending on the things that they need to. I know it sounds like semantics maybe, but I guess if I'm just like, hey, I still want to spend money, I'm just not going to be frivolous with spending. It's different than saying, hey, I'm only buying food, gas, and, paying my mortgage, whatever it may be.
Well, I think it depends on which consumer cohort. And so there's the ongoing debate of the K-shaped economy. Now we've got this thing called the C-shaped economy as we see some of the low-income folks kind of re-enter the picture. But it is very bifurcated. The reality is let's just take the very high level. Consumers at large. Consumers at large have faced essentially flat and stagnant real income growth. But they face very real challenges on the inflationary backdrop for all of the things that they have been buying. What they've been doing is they've been drawing their savings rate down and or taking on debt. But as we get into the individual cohorts of that high versus low quality consumer, the primary difference has been that high quality consumer, that very high income, high FICO consumer, has a lot of financial assets. Those have continued to move up, and that has really buoyed spending.
Shenanigans.
And so I think you're seeing just broadly a pullback of spending across the board as pocketbooks get a little bit tighter. But especially as you enter some of that lower, the bottom half of the income group, you're seeing that consumer be very, very choosy around what they want. But thus far across the board, we're not seeing consumers really focus purely on just basic necessities, but they definitely are getting more choosy on where they spend.
Okay, and I think a good point, because even though we've seen inflation cool lately, many categories have remained relatively sticky. And so as investors do look ahead to, say, Jack's poll in the September Fed meeting, well, how should they think through the odds of, say, another rate hike, or how do we assess now the Fed's next move, of course, as we all try to do, and then seemingly the Fed does what it wants anyway?
Well, we should celebrate that last fact. The Fed is supposed to do exactly what it wants, right? The market is not supposed to be dictating for the Fed what the Fed should do. And that's a little bit of the challenge that I have now. And so one of the most interesting things out of that last press conference that we got was this is the first Fed in a long while that celebrated higher rates. The market is doing a lot of the work for the Fed. And eventually the market will require that the Fed follow suit and the rate. Otherwise, long-term rates should stop. But the way that I would talk about the economy has changed tremendously. You're no longer in a period of disinflationary forces. You're in a period of inflationary forces. The whole backdrop of Jackson Hole is to look at how the economy has shifted, how the bank disintermediation has played out, and to assess the impacts. So I think that we're going to hear from Chairman Warsh a little bit more on some of these subcommittees and recognizing how the economy has shifted and how the Fed reaction function needs to have shifted. But you're 100% right. When we look at the diffusion indices within core PCE, within CPI, there is still a very large part that is rising at 3+% inflation, and there's very little that is staying flat. So the Fed has some cover, but the way I phrase it is I think this Fed is still looking for a reason to hike. And the data just hasn't given it to them yet. But I think as we look forward, the inflation genie is not back in the bottle, and I do think that will be an action.
Yeah, and Jeffrey, we have kind of a period of inflationary growth as well, as we were just talking with our last guest, how impressive some of the earnings are from some of these big companies right now. When you kind of take that into account with your discussion around how rates are, significantly higher than they were maybe 5-7 years ago, is that necessarily a bad thing if we can continue to kind of keep the economy growing? Like, usually really ultra low rates are kind of because there's no inflation, there's no growth, it's stagnant. That's kind of a different type of problem.
Well, you're right. Both are challenges. I think the biggest thing that I would say is the markets don't like change. And so what we are adapting to is, again, moving out of that world of a disinflationary impulse into a because the U.S. is bringing nominal GDP at the 6 to 7% range, and that is just absolutely tremendous. Rates are well under 6 or 7%, and so they're not truly acting as the rate that ultimately I think that they're going to have to be. But on the flip side of this is that consumer is now many years into those inflationary challenges. They're many years into these higher rates. They're many years into more housing affordability, and we are seeing this play out. So look, if I had to choose one problem to have versus the other, I would choose the high rates, high growth problem all day long. But again, what that just means to me is this is a healthy business cycle playing out. There may be a little bit of over-exuberance within markets. Earnings growth are strong. That will support continued strong employment growth. But that only means inflation is that much more sticky, which means that this Fed has work to do. And I think that they will get there.
Stop. Okay, I like that. Optimism, of course, to close things out. Really appreciate it, and great discussion today around all of the expectations, of course, for the Fed and the consumer environment we're currently grappling with. Thanks so much, Jeffrey Klingelhofer, Portfolio Manager at Aristotle Funds.
Jeffrey Dinglehoffer.
Tesla is looking to roll out its
All right, Netflix pulling back from the high.
So we'll give all of the details. We'll be right back.
We did take out Friday's high.
Is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on SchwabNetwork.com. Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network. Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
And on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are. I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Hey, Bob. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable. Wait, had a stroke? Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time. Jim, probably mad 20 years ago. Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Welcome back to Next Gen Investing. We're going to check on these.
Okay, watching NVIDIA. Netflix is fading a bit more. NVIDIA getting some attention.
Russell 2000 not offering much relief either, down 1.1%. More modest move to the downside in the Dow, down about 0.2%, and the S&P 500 now down almost 0.6%. So as we look at the Nasdaq here, we did see, again, some stabilization from session lows, but all that to be said, pretty brutal move to the downside today, Alex. And it's interesting because there's some
NVIDIA trying to go here.
in the Nasdaq today.
Yeah, and I like that you bring that up because, and it's not just the Nasdaq, it's the S&P, right? We just got done at the top of our show saying how it's kind of a quiet week. There's not a ton of catalyst. The movement is so contained. Well, there's always exceptions to that, right? When you look at the semiconductor and semiconductor equipment industry group, which we have here up on the screen, it's a subsector of the information technology sector. To me, this is the embodiment of where that movement has been, not only this year, but for the last several years in reference to that AI infrastructure trade. Well, today it's accounting for 52 points worth of downside to the S&P. Well, we're only down 43, Jenny. So this is 120% of the move. We'd be up if you just took these names out of the S&P 500 today. But they're not alone. You see names beyond this industry, whether it's Caterpillar, which is associated with the AI trade, whether it's a name like Vertiv, that's associated with the AI trade, under pressure. We were just joking in the break, how volatile some of those equipment makers like Lumentum and Coherent are in sort of that optical area. Those stocks are down over 10% today. So the AI infrastructure trade as a whole under significant pressure today.
Yeah. By that heat map, which is a good call out because we're seeing that stark red really across the board in some of the driving forces of course, our overall market. But now to shift our focus here on some news we got from Tesla, which was at least initially seeing some strength today. Now we've given back a bit, all of that and some. We're down about 0.6%, but Tesla has reportedly begun deploying the launch of its various driverless vehicles through several stages of testing. They have now conducted various test drives, provided employees with rides on these private roads, and also trained some local first responders ahead of this potential deployment when we will see the release further of the Cybercab. And so those are expected to begin their rollout in Austin. They're first going to again offer rides to employees on these public roads. This was first reported via the information on Monday. But the company then could add its vehicles to its robotaxi service in Austin just days later, according to this report. Now, Cybercab is designed specifically for autonomous driving. It does not have the conventional driving tools like a steering wheel or pedals. However, late last year, Tesla's board chair did say the automaker remains open to equipping the Cybercab with more traditional vehicle controls. But again, they have been preparing for this pretty major launch, and this commercial Cybercab rollout would represent a very much important milestone in their autonomous driving ambitions. Musk has repeatedly promoted robotaxis as this major potential growth opportunity for the company. And they did highlight this on their most recent earnings call, saying that they've started doing Cybercab rides in their Austin factory. Meanwhile, we know that Waymo has also been very competitive in this space. They did say last week they secured California approval to significantly expand their own driverless ride-hailing operations. And so, unfortunately for Tesla, they're pinned against Waymo, which already has a full fleet that's somewhat operational and not in the like fully autonomous way that Tesla's trying to be, but we've seen the difference of the technologies, of course, using to power these various entities, I think, rival one another. And Musk has been pretty transparent about they will not follow Waymo's steps. They will not use the same type of technology. But unfortunately, that's been a bit more of a negative, it seems, for like the broad rollout.
Yeah, this is, well, it's a good update, right? Well, whether or not it's ultimately what happens, we now have an expectation. So you kind of have a timetable you're expecting to see this roll out. You have a phase in which it's going to happen. And so for Tesla, it's still to me a medium to long-term story and catalyst, but we now have something to measure against for what it will look like. And, you know, for someone who wants to see this technology continue to grow, whether it's through Tesla or Waymo or some other name that we don't even discuss, it seems like a meaningful step for the industry as well. The Cybercab's kind of an interesting looking vehicle, but, you know, if we're really going to have autonomous driving and there's not going to be a driver, let's use that seat for another passenger.
I know it is interesting. I've yet to be in one of these vehicles. I could be trading of some of these programs, but we know that Tesla, unfortunately, has been very much tied to some of the volatility of SpaceX, at least with its own Tesla-specific news today. But I mean, we've pulled back about 32% from highs, and so we're down 25% on this year, and almost erasing all of now the gain we've seen now over the last 52 weeks. And so what has been a substantial move lower after its earnings, we've tried to rewrite some of the lost momentum, but today has just been, unfortunately, really the black eye of the Max 7.
Yeah, we wondered what was going to happen when SpaceX was another way to get kind of Elon Musk exposure. We've talked about Tesla being that for so many for so long, and we wondered if it'd be negative. And, you know, I'm not going to say it might just be correlated. You know, it might not be the cause for some of that weakness, but so far the debut of SpaceX, not been the rosiest of things for Tesla.
No, it is not. It's like, if anything, it's highlighted like the various entities that Musk runs. And while it's difficult to go against him, it also does signal, I mean, some growing pains with both of these companies that are fairly uneven on the profitability basis. Not Tesla, though, but free cash flow is obviously still a going concern in the most recently reported quarter, which is hugely why we saw a pretty major pullback. But we'll leave it there for our Tesla discussion today. But coming up next, we will discuss an under-the-radar mover in today's session. Next Gen Investing will be right back.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more, all crafted just for traders. And with guided learning methods, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning.
0 DTE.
Trade brilliantly with Schwab.
0 DTE.
Real-time market moves, earnings, breakdowns, and trade-ready insights. Follow me on X_Bardas and connect with me on LinkedIn or Instagram.
How's it going? First day, so sometimes, you know, next, try it again. You could have done better. Please. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Schwab coaching is concepts brought to life in the real world.
It's absolutely world class. We have coaches who have been in the industry, around the industry for a long time.
We have different formats because people learn differently at different times. We have webcasts running through YouTube all day, every trading day.
We've got events that are making their way around the country.
So you get that opportunity to share experiences and knowledge with other traders.
How incredible is that? And it's free.
NVIDIA looking for a push higher. Markets are just sitting here following.
Download the Schwab Network app and stream live coverage wherever you are.
Welcome back to Next Gen Investing. Deere reports earnings this Thursday. Focus will be on any signal that the agricultural investment cycle is finally seeing some stronger growth as well as profits. Deere shares have outperformed this year, but now are carrying carrying a premium valuation relative to their peers, expectations are only then heightening, of course, going into this report. But now joining us to discuss what the company needs to deliver is Tom Essay, the founder of the Sevens Report. And Tom, thanks so much for joining the show today. Deere has been one of the biggest beneficiaries of the ad super cycle narrative. And so what does that company really need to then show this quarter to prove this theme is actually translating into stronger business fundamentals?
Good afternoon. Thank you very much for having me on as always. Yeah, so this is interesting. Deere has traded very well, as have a lot of the machinery and the industrial names. But Deere has benefited from this idea of the ag super cycle, where all these deeply ingrained agricultural companies are going to benefit from massive food demand, general commodity inflation, all these sorts of things. The stock has been bid up ahead of that. It's up nearly 20% year to date. But the financial results have not really come to fruition yet. So now we're getting to what I call a show me state with the stock. It trades at a substantial premium to its industry peers. So as investors look at this upcoming earnings report, they're going to want to see strong margins. They're going to want to see net income guidance raised. There's a lot that Deere is going to have to prove if they're going to rally out of the ground.
The story of execution from Deere more so even than just sort of the macro stuff that's happening? Like, is this a company that's been able to, balance sort of the tariffs, everything with the volatility of this industry to continually have those industry leading margins? And is there confidence that they can continue to do that?
That's the big question, right? Margins are going to be incredibly closely watched in this report. AGCO, who's one of their competitors, reported a little bit ago, and they actually had strong sales, but their margins collapsed. So they obviously cut price to generate revenue. So now there's a lot of people looking and saying, well, look, Deere has been able to maintain margin, in part because their brand is so well respected, well known. Are they able to do that if demand isn't accelerating as we thought there would? Now, the macro fundamentals do appear to be positive. You're talking about huge crops coming into the system out of the summer. I think it's going to be the largest corn crop ever, perhaps by bushels. So there's demand there, but do they realize it, and can they keep the margins without having to cut price?
Yeah, that's a good question. And I mean, one concern has also been the expected net income that's been stuck roughly between 4.5 to 5 billion for several quarters now. And so what's really the significant behind that number?
Well, it's if we think that there's this super cycle coming, and I'm going to bid up the stock because I expect that earnings are going to turbocharge, well, then sooner or later they have to start turbocharging, right? I mean, it's not like anybody's buying Deere because they all of a sudden think the multiple, the long-term growth of the stock is going through the roof. This is a company that should benefit from strong macro fundamentals impacting their industry. The problem is they're not raising their net income guidance, and they haven't for several quarters. So sooner or later, we have to start seeing expected higher income. Otherwise, everybody's going to turn around and say, well, wait a second, this is all great, but the company isn't making more money than like we thought they were going to.
When you kind of compare Deere to AGCO or I think CNH, another one of these names, is Deere going to be able to continue to carry the premium multiple if it trips on any of these tests?
It'll stay premium, but the spread will come in for sure. I mean, I think Deere's benefiting from a lot of things. The ag super cycle that we talked about, the fact that it's a machinery company. Look, Cat had a huge earnings beat. Cat isn't the same as Deere, but they're not in totally different neighborhoods either. So I think that Deere is benefiting from this kind of just peripheral positive. I think they are best of breed within this sort of segment, but their multiple is really high compared to their competitors. So if they don't meet these high expectations, that multiple will compress. We'll still trade at a premium, but not almost a double like they are right now.
Unfortunately, it seems like the success of some of these companies ends up being almost the detriment for these earnings moves. But still, of course, a solid performer this year, modestly pulling back today, but really appreciate it. Tom Essay, founder of the Sevens Report. That'll also do it for Alex and myself for Next Gen Investing for this Tuesday. Thanks for joining us throughout the last hour. Don't go anywhere. The watch list is coming up next.
0 DTE. Stop.
Okay, S&P continues to fade. To hedge on the downside, if you think we're going to be seeing more downside, you could try some SPY put flies, I would do 760, 750, 740 or something like that. 760, 755, 750, maybe. Okay, so if you're thinking that we're going to see more downside, a cheap way to hedge would be buy a 760. All right, so we'll color this green. Buy the 760. Okay, let's color this green. Okay, so more narrow would be less costly. So let's say you buy the wings 760 and you buy 740. Well, that was what I was looking at originally, 740s. And then center your butterfly around 750 in case we pull back. Once we start to touch this upper line, as you're moving towards that level, you're making money. And what you do is you buy one.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute. With shows built for action, we break it all
Sell
down in real
times 2 and you buy times 1. All right. So for each wing, upper and lower, each wing is 1. Okay, 1 long on either side and then 2 short in the center. That costs you about, I don't know, let's see what it costs right now. Let's see.
I don't even know if they could envision it to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to
It'd be under $1.
company that can help me give my family a happy financial future.
Okay, spy. Let's see. I would go out to maybe the 28th. That's next Friday. Not this Friday, next Friday. Looking at the puts for a hedge, a put fly. So 760. Let's go 755. 750. Okay, that's 30 cents. All right, so you buy 10 of those for 30 cents. Let me just do it the other way. Let me do 10 of these. So you buy 10 of the wings on either side and you sell 20 in the middle for 30 cents. So for $300 hedge, you could make a maximum of $4,700, $4,700 if we continue to fade.
And the Russell lower by over 1%. As you take a look at the heat map, you are seeing a lot of weakness across the board. Most of these sectors here in the red. Well, actually, I'm going to correct that. Tech is down the worst because that's down 2%. Industrials are down 1.25%.
Okay, so for any butterfly, these are the most efficient ways to hedge on the downside. Usually, puts are cheap, so any pop in volatility, these would jump. Okay, so you pay 30 cents for something that could jump $4 or $5 per fly. So you buy 5, $150, could net about 2,500 max if we were to pull back to 755 and close by the end of the month. With a put fly, you need price to close in the center of the fly. So in the center, this would be 755 or 750. I like 760, 750, 740. Easy to remember. 760, 750, 740. Those are less than $1 each. With a big payout if the markets do pull back.
Zero DT.
That's with implied volatility low. So we're expecting implied volatility to pick up. So you would do the opposite of this. If implied volatility is super high and core 1M is down at 4 or 5, you would be selling these butterflies instead for premium because the implied volatility is high and you capture the implied volatility. Let's see. What are we doing here? Okay, NVIDIA, what's NVIDIA doing? All right, NVIDIA, no follow through.
Then you look at the yield side of it also. And I don't think it's necessarily the yield moves. I think it's more the velocity of the yield moves because I think we've got a chart here that kind of tracks the S&P 500 versus the 10-year yield, right? Historically, you can see yields rising and equities rising together, right? Sometimes that's good if you're expecting GDP growth to be pretty robust at this point, but I think it's the velocity that we've seen in the yield moves. Now, yields, the 30-year, the 10-year, they're off the session highs hit earlier on in the session, but equities haven't rebounded a little bit. I think we're coming to some type of inflection point. If we continue to see yields move to the upside and not consolidate or even pull back a little bit, that's going to start worrying what's going on in the equity market because we're at or near all-time highs, right? You get a little bit more susceptible at this point. You mentioned the fact that the S&P 500 equal weight index was actually positive earlier today. I think it's right around the flat line now. But if you see a big move to the downside in information technology, like we're seeing today, it's the biggest major component within the S&P 500, the NASDAQ 100. You're going to see some weakness. NASDAQ down like nearly 1.75% today. The DRAM ETF that follows a lot of those memory stocks, which were all moving to the upside yesterday, they flipped and now they're all negative. DRAM's down over 8% in today's session. So the volatility continues in that space, but typically that might be what happens when you've got overextended equity markets like we did at the end of last week with the small caps at records, S&P 500 hitting records on Thursday, the NASDAQ making inroads since the start of
S&P SPCX did gap down. It is rising presently. SPCX. Okay, it came off of the gap down low. SPCX.
If we continue to see yields moving to the upside, that's going to definitely put some pressure on sectors within the S&P 500, especially information.
All right, SPCX did hit the low and turn back up. It's still an inside day for now. What's Cerebrus doing? CBRS. Big reversal on CBRS. Chips, all the chips took a hit today.
Social media, privacy, addiction, the opening arguments underway. Some of our thoughts here. What do you think?
Yeah, it stock's under pressure. It's been underperforming due to maybe the head.
Preseason will be warm.
Is that someone else who was saying that about
It's the CEO of a tech firm.
If I'm the Fed, then if we're still in preseason, and we see reports, we talked about this yesterday a little bit about off-balance sheet commitments by, is there anything that they can do then to make sure that this is a perfect season with a great championship, and then we can be the Warriors and win for like 7 straight years and not have to worry about it?
So if you look at things through the lens of earnings, what I would say is, given that we don't know what this whole cycle is going to look like, how strong it's going to be, but you can look at the slopes and where we are is Q1, Q2 is an acceleration, and God forbid Q3 maybe yet another acceleration.
We know that.
So that means it's still early.
Well, even if we're early, there is undoubtedly misallocation of capital and overinvestment. That just defines every infrastructure investment boom that we've ever seen. Now, obviously, it's going to end. That could be 3 years, could be 5 years. From a diversification point of view, because I hear wealthy investors say, on the one hand, you need to diversify because everything's so concentrated now. Even in private markets, everything's very concentrated toward a leveraged AI trade. On the other hand, even wealthy people who are in sort of wealth preservation mode say, why? Because there's one thing working, and that's AI. Why would I want to diversify out of that? What do you think investors should do when they think about diversifying in a world where there really is only one trade that's going to, however long this goes, is going to carry us? It's not going to be industrials. It's not going to be financials. It's going to be everything around AI.
Well, I mean, I'd slightly disagree because when we had that sell-off during June, it was the S&P equal weight that was hitting new highs as the S&P.
Yeah, how long did that last?
Well, it's still hitting new highs.
Yeah.
So it's still a weak.
But I mean, in terms of the broadening of the.
No, I think we're starting to see more of a broadening now. And when you talk about a tech CEO says we're in the early innings, no one's ever going to say we're always going to be in the early innings. So at the bottom of the ninth, and we're about to go maybe over. We actually did a survey a year ago, and we asked people what inning of the AI boom you were in, and they said the 4th inning, and then we did it a year later, and they said the 3rd inning. So those kind of analogies, I don't think you want to. When you hear that, you want to say, okay, I need to be bullish because we have 6 more innings, even if we don't go into extra innings. But so you want to broaden your perspective, I think. And if you go back to the .com bust, and I'm not saying
Cerebris, no follow through.
Up until 9/11,
The chips are pulling back.
was up. Yeah. The S&P cap weighted index was down about 30%. So in that respect, it's crazy. So everyone thinks of that period. Look back, oh, the market fell 50%. It was terrible. But the market held up great until 9/11. Right. Then you saw the fears of the Enron collapse and WorldCom, and that's when everything fell up. But having that broader exposure really helped to provide some cushion the blow for investors. So I think as you see these AI trades keep going up and up and up, you just peel a little back and you go into other sectors.
What other sectors would you recommend?
Well, so one of what we've been doing is gradually adding our exposure to the equal weight S&P 500. But so one of the things we were looking at yesterday is turnaround.
Lowe's has earnings tomorrow. Probably going to do an iron condor. I posted what I thought looked good today. We'll adjust it tomorrow.
One of them that's really interesting stood out to us was UPS. UPS has been mired in weakness. It's down 15% during this bull market. Trades for 15 times earnings, yields 6%. For now, it seems to have the earnings to cover that yield. We'll see. But the big weight was Amazon losing the Amazon contract. Yeah. And that's starting to wind down. In the last 4 quarters, they've reported 3 earnings triple plays, which is when companies report better than expected earnings, revenues, and raise guidance. And they hadn't reported a triple play since February 2022. So they're starting to see some of that turnaround here. I think that's the thing where valuations are really cheap. There's a ton of skepticism towards the stock. It's a complete opposite of the memory stocks right now.
And Binky, anything similar on your radar?
So what I would say is, on tech, we are actually currently overweight. If you look at the last 5 rotations, basically, there's been plenty of them. We are sort of tracing out almost perfectly this trend channel from top to bottom. Right. We are in the middle of an upswing. We have to be right in the middle, so I would stay long. I would ignore the narratives. I would argue this is about performance and positioning. I would slightly disagree on the take on the 34% earnings. The way we calculated that it's just AI, for example, if you take the AI.
All right, what's Copart doing? Copart, nice trend break, CPRT.
And you take the rest.
We did dip a little bit from the opening range high. The markets are a little weak. We gap down into a doji tight range.
So if you have big concerns about AI,
Seven sectors at double-digit growth, right?
we have 8 sectors. 8 sectors. Yes, 7 accelerated in terms of growth.
A lot of negative gamma down here. So prices could accelerate to the downside.
And perhaps the media about this market, because it's the perception is it's the only driver of profits, the only driver of the broad index gains, and it's the only thing that's working.
So what I would say is that was very true for 2 years, 2023, 2024, but the story began to change in the second half of last year. It's continued to change, and I would say, a simple way of thinking about it is if you're looking at equities in the old days, you would say, I only need one indicator to have some actually. That just ran vertical in the first rate. Yeah, February. So how long is the cycle? It's 4 months old. So what's sitting below 50 for 3.5 years? Yes.
Next time Paul's back, well, that's fair. What's before preseason? The draft? Maybe we'll be in the draft.
That was too fun. Thank you, Chana, Deutsche Bank, Paul Hickey, Bespoke Investment Group. Quick look at the energy sector. Speaking of broadening, it hit a fresh all-time high today with heavyweights like Exxon, Chevron, and Conoco all moving up. It comes as U.S. diesel crack spreads surpassed 100. Or diesel is 100.
Diesel crack spread. Yeah.
Spreads are
The spread is $100.
okay. Yeah, that is crazy. So as the Iran war jet, what does that mean? It means that the product, we're seeing the shortages, we're seeing refineries taken offline. That's pushing up the price for the end user. We have a whole lot more for you this hour. The epic drama that the sale of the Lakers has become, and AI anxiety rising. Andrew Yang says he has a solution. We'll talk with him about an AI tax, and we'll go to the floor of the SIBO for more on the bond route. But first, we'll speak to a former OpenAI researcher about guardrails on the technology. Stay with us.
CBTG.
CDTG.
On ESG. CDTG.
CDTG.
All right, just watching S&P starting to rally up now.
On ESG. CDTG. On ESG. CDTG.
Okay, looking for a bounce on the S&P, looking for everything else to go with it. Okay, we're back above 7,700. That's a big plus. Doji. Cheap insurance would be put flies. Okay, buy a put fly for under $1. Gives you some decent protection if we do slide a bit lower. I would center it around, say, 7,600. So if you did Let's do SPY. SPY is easier. If you did SPY, I would do like 760, 755, 750. Or do 760, 750, 740. A little bit more expensive, but bigger payout if we drop through 750, or if we head towards 750. So 760, 750, 740, some combination of that. Okay. Equidistant from each other. You want to sell two of the contracts in the middle and buy the wings, upper and lower. 760, 750, 740, something like that. So you would buy protection, buy a put fly.
How would you describe the culture of the company firsthand from your experience? And
Conversely, or you could do it at the same time, you could also buy call flies, very cheap call flies for the end of the year or end of the month. Do something like 775, 780, 785. Cheap. Okay, well, we got a nice little bounce here coming. Nice little pop here.
Each of the CEOs fears what would happen if another CEO got to superintelligence first. In case you haven't heard, they're trying to build superintelligence, which means AI systems that are better than the best humans at absolutely everything, while also being faster and cheaper.
I'm so glad you brought this up because, look, to me, I'm the non-expert, and that's why I'm glad that you're here. I'm unconvinced by this idea of superintelligence. It just seems to me like these are smart tools, but I don't understand why people think there's going to be some quote-unquote breakthrough that puts them into a category that they're not currently in.
So I would say that I'm just doing basic trend extrapolation. If the AIs continue getting more capable at more things in the same at the same pace that they have been getting more capable at more things, then in the next few years, unclear exactly when, but sometime in the next few years, they will succeed at fully automating AI research. And from there, the trend line should bend upwards a little bit.
All right, back to VWAP.
It's probably not that far away from AIs that can do everything. I can get into more details if you're interested.
Let me put it this way: when I read about the details of the Hugging Face, the machines are not waking up and saying, "Let's attack someone today." They're following directions. They're carrying out orders, and so obviously we need to put more guardrails or code into what they're allowed to do, whether they're allowed to hack other companies in order to achieve their goals. But they're not on their own deciding, to go out and explore and do that. I mean, there's no brain there. They're simply carrying out orders. So the fault lies with the people who are giving them those orders, to me.
I mean, certainly there's a lot of fault to go around, and I would definitely fault the people at these companies for allowing this to happen. But also, it's actually a myth that the AIs always just follow orders. There are many documented cases of AIs disobeying very clear orders, and in fact, there's evidence in this particular case that the AIs understood that what they were doing was outside the intended scope of their task, and they did it anyway. If it was so easy to get the AIs to not hack other companies by just telling them not to do it, then that would have worked. They do in fact have brains. They're not, wet biological brains like ours. They're artificial brains. They're called artificial neural nets. That's how modern AI systems work. They're not like ordinary software.
Danny, you make a lot of really great points that are also scary. What you hear from the AI side, and a lot of people in government, is that, well, we're in a race with China, and we cannot slow down our innovation because China's going to win and they're going to dominate, and therefore we can't slow this down. What kind of regulation do you think makes sense that would still allow us to at least be in the race with China? And is any kind of global regulation even feasible?
Yes. So one thing to keep in mind is that these companies are planning to go much, much, much faster than they're currently going. They're already going very fast, as I'm sure you're aware. Growth in Anthropic and OpenAI revenue is historically quite something. I don't even know if there are other companies of their size that have grown that fast in recent years. And if you've been following the field of AI, the AI capabilities have been going up very fast over the last couple of years. But they're planning to go much faster, and their plan for how to go much faster is to put the AIs in charge of the research itself, the research and development.
Yep.
So that's what Anthropic in particular is most focused on. That's what OpenAI is most focused on. They're trying to make the AIs really good at autonomously coding,
right?
And then the next step after that is autonomously doing the entire research process. And it is generally understood that things go faster when you automate them. And so the AI research process, as fast as it is now, will go much faster once it's been fully automated. So one thing I would say is that they should not be allowed to do this. You can call it a slowdown, perhaps. It's a slowdown relative to their current plans, but it would still be an overall.
Okay, Intuit.
Stop the machine from creating their own. I mean, once you've set this in motion, isn't it difficult to stop machines? You told them to self-improve. They're self-improving. They're self-coding. They're going to soon start creating their own tools that aren't even tools that we asked them to create. So once that's all in motion, how do you? There is no kill switch for this.
Currently, there's no kill switch for this, which is why we should not do it in the first place. There should be domestic regulation to prevent the companies from automating AI R&D and passing off their data centers to autonomous forms of agents. And then we should start negotiating with China to get there to be some sort of regulation that's similar over there as well. If you're interested,
Netflix continues to climb the list of NASDAQ 100 stocks.
which is an illustration of a particular ambitious plan for how you might achieve this.
Where is it on S&P? S&P.
We'll focus on A for now.
Daniel, I'm curious if you could, to the extent you feel comfortable, tell us about your own career path. You were at OpenAI. It sounds like maybe that experience is taking you in this direction. Company's seen a bunch of executive turnover. Don't know if you have a comment on that and what it's kind of like, what the culture is like internally. Can they be trusted with something this important?
No, they cannot be trusted. Nobody should be trusted with this amount of power. The companies have convinced themselves that they are the good guys and that they need to win. And each company has their own special variant of this narrative, explaining why they, in particular, and they need to win. But ultimately, what's going on is that they're sort of rationalizing arguments to support the bottom line, I think. And this is part of why I left OpenAI, is that I became convinced. When I was first at OpenAI in 2022, there was this sense among my colleagues there that, of course, we would automate AI research with the AI self-improve as fast as possible. Of course, that'd be dangerous. We're not going to do that. We need to study the risks, study the dangers, so that we can figure out how to make AI safe. And that's why we're the good guys. We need to, beat Google, for example, so that we can use our lead responsibly. That narrative changed even while I was there to more of a it's going to be fine. The best way to make AI safe is to learn by doing, and to run into the problems as they come up and then fix them as they come up, which was the sort of new narrative that took over while I was there. But the narratives keep changing, but the bottom line stays the same, which is that we need to win.
Quickly and finally, there have been a few different proposals about regulating AI. Some focus on regulating the sandbox, which it's broken out of to achieve some of these hacks, to give itself high marks, for instance. Others, like I think Mark Zuckerberg's plan is
Netflix.
With the development of these tools along the way. So now, for instance, maybe to just say where it can and can't use the hacking that it's learned, the social engineering. Do any of those proposals land with you? There must be, is it a separate body that you would like to see, kind of a clearance? Is it something with the Federal Transportation Commission? What would that look like?
There's a lot of different proposals that I think are promising and way better than our current default of nothing. The thing that I would emphasize is that the high-level goal, one of the high-level goals should be to prevent these companies from doing an intelligence explosion, from automating the AI research and having the AI go faster and faster. And in order to do that, you need to do more than just look at external deployments of the models. You need to look at what's happening inside the companies as well. These big AI companies, that is. And another pillar I would recommend is transparency. I think that right now there's this huge information gap and this huge expertise gap between the AI industry and everybody else, including the government and any possible regulator that you might set up. And this creates perverse incentives and biases when it comes to evaluating costs and benefits and risks and so forth. And so to the greatest extent possible, I think it's important for there to be transparency regulations that require more information to be published. about what's going on.
All right, Daniel, to us, there's no more important issue right now, culturally, economically, financially, than safety and how regulation pans out. What we really need are people like you that actually understand the systems and can advise on the regulations. The last thing we want on either side is for people in Washington who don't understand the LLMs and the systems to regulate. So we really thank you for your expertise and hope to see you again.
Okay, Netflix, Copart, CPRT. I'm probably going to add to this one if it can follow through. Okay, Copart looks okay. 35.40. Call spread. Netflix. Let's see what's happening here. There goes Google. Google's on the move. Google pop in. Google end of day. There was some activity earlier. I don't know if you heard it. Shenanigans. Google, not the L kind. Google. Several times today. Google. There goes Google. Okay, there goes Google. Pulse alerts earlier, shenanigans. There goes Google. Okay, Google, what's on the news here? Google, anything? Google, convertible bonds are new AI bet. The high returns hide bigger risks. Okay, so let's see what's the deal here. $500 billion borrowing binge. Okay, Google obviously will be on this one. Alphabet, Google. They did a $10 billion thing with Warren, right? Google. Earnings. That was another one that gapped up on earnings when I was out of town for my birthday. Google.
Bond yields around the world on the move higher. The JGB 10-year is at a 30-year high. The French and German 10-year yields also at levels not seen in the last decade. Let's get out to Rick Santelli for more. Rick.
Interest rates moving up in every country.
Heads up, listen to Rick Santelli. This guy knows what he's talking about.
Right now, meaning UK rates, well, we don't see them making fresh highs, but they're very lofty, well above 5%. My guess, Mike Palmer, he's mostly on the equity and volatility side, which makes him the perfect guest on the day where interest rates are in focus in every major advanced economy in the world. Is that something stocks are going to pay a lot of attention to? Are they paying a lot of attention to it? Is it something that could take the punch bowl away at the fun equity part?
That's a really good question. I mean, we have seen the Iran war was a catalyst we had. We also had a catalyst related to just oil prices and different things. But the truth is inflation and higher rates are really what are like the biggest drivers, potential drivers for volatility in the marketplace. And it's important to recognize right now, we are in a new era. We have a new Fed chief. There's a new way he wants to communicate with the marketplace that kind of gives us less information going forward. But that doesn't mean it's worse information, right? We're going to get news as it relates to interest rates and probably will have some effect on the marketplace. We have Jackson Hole later this month. We have a CPI number in September. We have a Fed rates decision also in September. So we're going to get some information going forward. We're going to see how that affects the market. But I do think interest rates are the primary driver, the primary catalyst of volatility going forward.
Now, Sunday night, we learned that the debt clock in the U.S. crossed that $40 trillion mark.
Holy
I know
shit.
That isn't something that should surprise anybody. And really, what's the difference at this point between 37, 38, 39, and 40 to service that debt costs a boatload of money? What are your thoughts? Do you hear more traders now looking at interest rates, talking about debt, talking about servicing debt? Is it?
I think it's notable. We've seen long-term rates rise, right? They're well above 5% at this point. People are talking about that. They're also talking about how the Fed will intervene in that world. I don't think they're going to be sitting on their hands. How that exactly relates to debt?
The market's not sitting on its hands. The market's not sitting on its hands. And there's another point that nobody's talking about, and it's the T-bill landslide. We now issue a lot of T-bills, and the reason why is not a good reason why. Think about when you do your mortgage. Well, if you think interest rates are going to stay the same or go down, take a variable mortgage. If you think interest rates are going to go straight up, you want to take a fixed mortgage. The U.S. government is floating its rate at a time where interest rates are going up. And 23% of our outstanding marketable debt is now in T-bills, and that could present a problem. Quick thought on that?
I mean, these are the questions of our time, right? It's going to be the questions for Warsh going forward. I don't know if any of that creates an immediate catalyst for the marketplace. Those all seem kind of long-term concerns. There could be an event where that becomes a catalyst for the marketplace, but it's hard to pick a moment where that will be the reason we sell off, right? That's kind of a long-term
Hundreds of billions of dollars of bills rolling over makes me perspire. Mike Palmer, it's always great talking to you.
Rick.
Robert and Kelly, back to you.
Thank you both. AI anxiety is climbing up and up. So what should we actually do about it? We'll get another
All right.
viewpoint on
Google, a little pop there. Selling into strength. All right. Baidu's down almost 10%. Baidu. That's the thing about Chinese stocks. You know, a lot of people get excited about them. I kind of frown on Chinese stocks only because they do these crazy moves. Look at this move on Baidu. Right? You want to buy that? I don't know. One day you're up, looks like you're going to bounce, and you're down 10% the next day. Baba. Baba gapping up, gapping down. I don't know. I can't seem to trade. We were trading these for a while, maybe 5, 6 years ago, but then I got out of it because it just wasn't working. There was a point where they were going to delist Chinese stocks. Remember that? IQ. Yeah, these stocks, nowhere. All right, so we got earnings tomorrow, Lowe's. We had earnings today in Home Depot earlier. That's holding on to the 50-day. I entertained the idea of selling an iron condor on Home Depot after earnings, but I thought to myself, you know what? I'm giving up a lot of implied volatility that collapsed during the day. So I'm more interested in Lowe's for tomorrow. Being Home Depot didn't move much, I expect Lowe's will do something similar. So if you're selling 30 deltas, I like to sell 20 or lower, 20 deltas, 15 deltas. I'm still thinking about that Microsoft bite on the buttocks. Last year, we took what was it? Let's see right here. Okay, this one here. Let's see. Plus. When was that Microsoft loss? Micron. January. It was for February. Remember the February? Remember that February Iron Condor we took? I wound up buying some puts as well. I did some other trades around the actual Iron Condor, and The net loss was $2,450. It could have been much worse had I not done some damage control. But this one still stings. All this 8 months later, it still stings. You know, I didn't do much in June, July. I didn't do much in the terms of credit spreads or iron condors. I did take a Netflix put credit spread. I did sell 5. I might double this up to $1,800. Okay, so 5 put credits. Might double it. Not necessarily the same strike. 70, 65. I might not do the same strike. If this moves a bit higher, Netflix, I'll probably add 5 a little bit higher, like 75, 70, something like that. If Netflix continues to move higher, I want to have about $2,000 on this one. Credit spreads, the ones that I did take to dates, $28,900, almost $30,000 in credits. This is just credit spreads or iron condors. The credits received close to 30,000. We'll be over 30,000 by the end of the year, just in credit spreads. There's another tab down below. If you look at down here below, where a lot of my positions, which I move in and out of these, but like the XII, I have core positions. I have core positions that I hold on to. And if the stock starts to pull back towards a stop, I'll reduce my exposure. If it starts to bounce, I'll add back. So just one way of seeing what my core portfolio looks like. Now, this is in addition to the TRBCX and RGAFX, et cetera. This is more of a longer term. This is very long-term stuff, right? So you can see I bought, my average on Home Depot was down near 260. Okay, Home Depot. My average was around 260. Home Depot right now is trading 335, 340. So, you know, the average is fine. As I come in and out of Home Depot. But if you're interested in where this is, it's on the main site. Okay. The closing print. Okay, so up here under positions is where that information is. Right there. I need to post a few more updated blog posts. Let's see how these are doing. Back in early July, I wrote about Lockheed Martin, Lockheed Martin. Okay, that's higher. Lockheed, Northrop Grumman, and General Dynamics. Okay.
It's all just ludicrous talking points that politicians say and then walk away while there's a mess left behind. I mean, if we continue with that kind of fantasy this time, there are going to be pitchforks out there, literally and figuratively. We need to start to scream.
Okay, back in early July, I wrote about these 3 defense stocks. We're looking for a follow through. First week of July, coming back from July 4th. Okay. Lockheed Martin, General Dynamics, which makes submarines, etc. Lockheed. These are all much, much higher. So these are longer term investments. Maybe I'll start covering these as well during the 12 o'clock session, 12:30, where I start talking about longer term investments. I'll start talking about the blog posts and following up on the blog posts. Northrop Grumman at the time was trading, was at 550. Northrop Grumman was trading at 550. It is now at 590 plus 590.
So 1 in 3 working age men is out of the workforce right now. I mean, this is already a not great situation for many Americans. Americans, that's about to get worse still. And which leads us to the question.
Okay, what's IWM doing, Mondo? See Mondo posting IWM. Whenever he posts IWM, I like to pay attention. Okay. All right, coming off the low. Yields, what are yields going to do? Are yields going to come back down? 10-year yield. 10-year yields at highs. Got to pull back in a little bit, down to the lower Bollinger Band. That would be good for a 3 or 4 day window in IWM. If the 10-year pulls back. Okay, Apple turning back up. Apple's on the move. Apple, end of day. Remember those September calls, Corey, I was talking about earlier? We're talking about getting back into those.
My kids are not very handy, also not very rugged. So I enjoy the class saying, look, to study what you want to study and then hoping for the best. They like math, which I think is going to be catnip for AI. So I'm not missing on that side. But what I advise parents is the important thing is what it's always been, just sociable, happy, well-adjusted kid. And then they'll be able to push through and find a role.
Andrew, we have the Meta trial starting today. They say it could be one of the biggest ever. It's 19 states, maybe more, trillions potentially at stake. And same question for you. I mean, people look back now and say, well, we should have regulated social media. Well, what should we have done exactly? Again, you understand the challenges that come with this. I understand when people say we should just keep the phones away. I wonder why Apple is not part of the conversation for not having clearer ways to kind of toggle on or toggle off the device.
Apple above the opening range. Earlier, we traded Apple.
I think the way this chapter is important for the way that the next one on AI begins.
We missed the boat on social media, and there is a reckoning right now for Meta. They have the data that showed that it was making teenage girls in particular anxious and depressed, having very negative effects. A lot of the families in Silicon Valley don't let their kids use this stuff. I want everyone to think about what that means.
Steve Jobs didn't let his kids play on iPads and stuff like that. It's pretty interesting when you think about it.
More and more disclosures and lawsuits are leveled against Meta, and hopefully it's not too late on it.
But the people who created AI are themselves the super users of it.
Yeah, it's a slightly different dynamic, but AI, as destructive as social media has been to the psyches of our kids, AI could be catastrophic in terms of, unwarranted military conflict, new viruses. We don't know what the heck they are, hacking of critical infrastructure. And this stuff is going from the edge case to the mainstream really quickly. I love the last guest you had on who just said, look, internally, OpenAI used to be more judicious and cautious, but now the market is taking over because they sense there's $1 trillion.
Okay, Apple.
And Andrew, you've been involved in politics.
There goes Apple.
What you see about this rising fervor in the Democratic Party with socialism, obviously some of that is related to inflation, some of it probably the impending inequities that are even going to grow with AI. Do you think that has legs, and do you think that can actually be electable in a mainstream Democratic Party nationally?
Robert, what I think is happening is that Americans are angry and frustrated. Congress has a 12% approval rate nationwide, and individual members have a 94% reelection rate. So if you run a business, imagine if 8 or 9 out of 10 people didn't like what you were doing, but then they had no way of changing it. And so they're lashing out different ways. They're reaching for solutions. They're reaching for anyone who seems like a change from the status quo, because their kids are coming back from college without a job, getting depressed, living in the basement. They see that their paycheck is not growing at the same rate as the gas prices, the grocery prices, the insurance bill, and the rest of it. And they're mad. And so the question is, how is that anger? Yes, how is that anger going to play out?
I mean, can an AOC or Mamdani ever be elected president?
No, I think that the Democratic Party is in a real quandary right now, because you have folks on the far left who are succeeding in certain precincts,
But then you need the military veterans like Pat Ryan competing in purplish districts in order to actually have anything resembling a governing majority.
All right, Andrew, so great to have your thoughts. Thanks so much for joining us. We really appreciate it.
Of course.
All right, let's get over to Kate Rooney for a CNBC News update. Kate.
Okay, Robert, the Justice Department is exerting President Trump's executive privilege in front of a federal judge, arguing the administration cannot be forced to identify advisors who were involved in last year's White House crackdown on major law firms. The American Bar Association is suing the administration over that effort, alleging the White House unlawfully targeted those firms for, among other things, their diversity policies and political ties. Meanwhile, ESPN now reporting that founder Bill Rasmussen has died free from the effects of Parkinson's disease.
Oh, wow.
Launched the first ever 24-hour TV network back in 1979 with his son Scott by maxing out his credit card and buying space on a communications satellite. ESPN chairman Jimmy Pitaro called Rasmussen a visionary and innovator by being the first to conceive of a network entirely devoted to sports. And finally, Pennsylvania Governor Josh Shapiro is expected to sign an executive order dramatically limiting data center development in that state. According to the Philadelphia Inquirer, the order does not include a moratorium on that development, but requires local approval to get state permits. Robert, back over to you.
Thanks so much. I mean, that was interesting. Josh Shapiro was at that data center ribbon cutting, so proud of it just months ago. So that just shows you where the tides are turning. Yeah,
exactly.
Amazing. All right, it's a huge week for retail earnings and for investors to read into the consumer. Our next guest has some favorite names jumping out to him within the sector. That's coming up next.
All right. Okay, Google retracing a bit. Apple, a little pop there and pulling back in. Apple. All right. Nike, what's Nike doing? Nike bouncing? Oh, say it ain't so. Nike bouncing. Big bounce on Nike. Somebody stepping up and buying. Somebody was buying. Somebody big was buying a few weeks back. Was it Kathy Woods? Wouldn't be surprised. Apple. Netflix. Okay, Netflix just hovering up here near 80s fine with me. Push it a little, grind a little bit higher. Netflix. Looking for it to break above the 80 level in the short term. Netflix. Pershing Square announcing or disclosing, I should say, better word, disclosing a position in Netflix. A lot of people like to buy in sympathy when Ackman is active. And in this case, he bought Netflix. Where did he buy? At the lows. Where would you buy? If you were a fund manager or a hedge fund manager, where would you buy? Where would you buy? Would you buy up here? Or would you be scooping up shares at a discount? So you know what he's been doing. Pershing Square, buying at the lows, looking for this to pop up towards the 200-day. Get back to 100 probably by the end of this quarter. Okay, they reported back in the middle of July. So we got another, what, 2 months, September and October, for Netflix to improve. Ackman tends to be very active when it comes to talking to management. He's not an activist investor, but he does jawbone a lot with the management of these names, of these companies. Netflix. Okay. Target has earnings. Okay, let's look at Target. You guys thinking about Target earnings tomorrow? Is it tomorrow? Target earnings tomorrow? Target earnings. I don't think the implied volatility is hot enough to sell premium. Target. Okay, that's tomorrow in the morning, 6:30 a.m. Target reports. Let's see. Target. Let me just see what Target's. Okay. Target. Okay, let's go see here. Target reports tomorrow morning. Let's look at retail. Do we have retail on here? No, I don't have retail. Okay, let's do retail. Let's see. New watch list. Retail stocks, all right. Let's go. Walmart. Where do I add? Okay, Walmart. No. Add symbols. Oh, there we go. Okay, so retail is the name. You can tell I don't use it that often. Retail. Okay, let's just throw a few names in here. Costco, Target, BJ's, Dollar Tree, Ross Stores, TJ Maxx. I guess we can include Lowe's and Home Depot in here. What else? What else? Five Below, Ralph Lauren, Estee Lauder, Macy's. Who else should I put in here? Retail. Any recommendations for retail? Retailers, anybody? Going once, going twice? Target is back up into the middle of its range for today. Thank you, Grover. 2 times our vol today in Giant J&J. Let's see. Ross Stores, Dollar Tree, Dollar General. AEO, American Eagle Outfitters. Gap stores. Gap. Retailers. Who else?
Like a scene out of Succession. Lakers Governor Jeannie Buss says she's blocking her siblings from selling the family's stake in the franchise to Bob Iger and Joshua Kushner. This comes just a week after Iger and Kushner agreed to buy Mark Walter's majority stake, a deal valuing the team at a record $12.5 billion. Michael Ozanian is here to untangle this. I guess if that's the word, Michael. So what happens now?
Well, right now, Jeannie Buss is saying she has a court order via 2017 that basically she and her siblings are not going to sell the team unless she agrees to. So it looks like Kushner and Iger, if they want to buy into the Lakers and buy Mark Walter's share, are going to end up owning about 65% of the team. The problem with that, from their standpoint, is Jeannie's still going to be the control person. She's going to have all the say, even though they would own the majority of the team. They have basically no say in how it's run.
So how is that possible? Is it sort of like super voting shares in a family controlled company, be it public or private, where the Walter Group owns 65%, but the Buss Group, which only owns about 18%, has controlling from a voting perspective? Is that kind of the analogy?
Exactly, Robert. It's basically the same exact thing.
Did they not know this? Were people not aware?
This deal happened so fast, it's hard to tell who knew what. I mean, it apparently transpired over just a couple of days. It came about, Mark Walter, of course, is in trouble, in terms of he's being investigated at the DOJ.
Yeah.
He's talking about selling his stake in Chelsea, the English soccer team as well. My guess is he'll eventually have to unload his stake in the Dodgers, too. I mean, he needs to come up with a lot of money quick.
So if the Buss family trust controls this, then
Okay, SPY. Let's see what SPY is doing on the 60-minute. Gapping down, 20 MA, rolling over. We are oversold already, so it's possible that we could bounce. I'm thinking that we could pull back a little bit more, so I would be entertaining. Maybe you could do 765, 760, 755. Butterflies. 765, 760, 755. If you're thinking about potential downside and need a hedge, 765, 760, 755, or 760, 750, 740, which is my preferred 760.
Should they sell that? Should the other siblings sell and not her, who would fall below the 15%? So what they're basically saying is, even if Jeannie personally owns less than 15%, she is still the de facto control person because the siblings altogether own over 17%.
This is why I love covering wealthy family fights, because they're inevitable.
I'd rather be talking about economics. I'm barely following. So I'm just going to keep asking. So what happens next?
Well, the other side is arguing that the siblings are arguing that they have tag-along rights. Meaning, in the agreement with Mark Walter, they were given the right, should Mark Walter sell, they could sell their shares too. But from the people that I've talked to, now they haven't actually seen the legal documents, but they say that the court order supersedes the tag-along rights. The tag-along rights would only work if indeed Jeannie decides to sell. Then the siblings would have the right to all sell it at the $12.5 billion valuation.
Isn't basketball fun? What are the odds that that Iger and Kushner actually get the team at this point?
Well, I think the hardest part is putting the financing in.
Yeah,
I don't know. I think even should Jeannie not sell, they would still want to consummate this deal.
All right, Michael, thank you. Michael Ozanian, Robert Frank. That's it for us here on Power Lunch. Closing bell starts.
Kelly, thanks so much. Welcome to Closing Bell. I'm Scott Walker, live from Post 9 here at the New York Stock Exchange. This Maker Breakout begins with stocks down, yields up. That really is the story as the market grapples with the move in interest rates today. Here's the scorecard with 60 to go in regulation. I'll show it to you there. Fair amount of red led by the NASDAQ, which is not surprising either, given growth stocks tend not to like rising rates. Chips are lower. The momentum trade cooling certainly today. There's NVIDIA off by more than 2%, but Micron down substantially, as is SK Hynix. Some strength in software, though, led by Salesforce and ServiceNow. Pretty good gains there. We'll track all that. Away from tech, we're watching Home Depot following its earnings reports. Kind of been all over the map today. It's currently green, and we'll see how it does, too. The home builders, they're red. Mortgage rates, they continue to rise. Right.
VIX starting to move higher.
And that takes us to our talk of the tape. The move
Talking about a 2-week window where we could see some earnings disappointments from NVIDIA or earnings surprise. If you want to hedge, think about put flies.
So what about this backup in yields? This bear steepening, the long end rising faster than the short end is continuing to be a story. What do we think?
I think it's fleeting. I mean, in the really short term, you can get a sell, especially with tech stocks up a lot in the last few years. But ultimately, when you study the long history of the change in rates versus the change in equities, there really isn't a statistically significant relationship, because usually, ultimately, if yields are high, it's because growth is good. And if growth is good, tech stocks and the stock market can do well. So but I think it's fleeting, honestly.
Does this have as much to do with growth prospects as it does these other, issues like the issuance of all of this paper, Fed communication, more focus on the deficit, debt, things like that? Is this really about growth prospects? Because the most recent economic data doesn't actually scream like, hey, rip roaring economy.
I think the economy's in pretty good shape. I mean, look, I guess the challenge always has been, if you would ask me once a year for the last 15 years, am I worried about the U.S. government deficit? Or sometimes when you ask it, are you at all worried?
Yeah.
And then I feel it ages like milk if I say no, right? But the question is like, should I change my portfolio positioning today for the inevitability that finally matters right now when it's been obvious for 15 years? I don't think so. I think ultimately the economy is strong enough. I think the earnings and cash flows from these big companies are strong enough that they'll power through any kind of scare that happens around this. One of the things I learned in the past is whenever you see people make the argument that bond yields will back up because demand be weak, they're wrong. That's happened 0 of the last 100 times that I've heard that call from the big bulge bracket firms. Because when people get afraid and there's truly a growth scare, then the 10-year yield goes lower again. So I'm not that worried about that. I think this is more positioning and a little bit short-term profit taking after a pretty big rip from lows in some of the tech stocks.
Okay, so
not a longer signal.
when you ask the question, should I be changing my portfolio as a result of this? I mean, that is a relevant question.
Yeah.
I don't think so. If you think that longer duration assets are going to, have an issue if yields continue to back up, so maybe the momentum trade does have a little bit of a problem for a bit.
Yeah.
Who knows? I mean, you don't know what yields are going to do. You also wait to hear from Kevin Warsh coming up. The Fed chair in Jackson Hole's not that far away. And by the way, NVIDIA next week too. There's a lot of variables.
In a 3, 6, 12-month view, I'm not worried about it. In a 2-week view, I don't know. Right? I mean, and you can see people being a little bit, afraid of this backup in a short-term view. That's why the home builders are down. Sentiment. Are you saying, if the question is the trajectory of corporate earnings impaired? Is going to be a real growth scare about that?
You don't think so? No. Margins are good.
Pretty good shape, but I think growth is pretty strong. And honestly, I think if I'm looking at the distribution of outcomes to say 2028 or 2029 earnings, I think they're skewed wildly to the positive, because I still don't think people truly get the impact that AI is going to have on productivity for a lot of the big companies.
Well, interesting. I mean, are you thinking about what the Fed chair may say next week? Or how are you thinking about NVIDIA, which is probably the biggest issue right in front of us? Now, you also have to put it into context. That stock's had a really nice move.
It's had a nice bounce off lows. Look, my view is that by the time this AI cycle is over, several years from now, this stock will be probably twice as high as it is now. Probably 10 trillion is the ultimate destination, if not higher. And the reason is they're going to grow at a really strong rate for a really long time. They have less cyclical earnings than, say, Micron or others. And I think they're the prime example of where the skew to the upside is out in 28 or 29. So near term, I think the challenge is everyone knows that quarter's strong, and the hyperscaler CapEx has remained strong, and they're a primary beneficiary. I think if you look out any meaningful period of time, this company's just going to generate a ton of cash flow. So I'm bullish on both Micron and NVIDIA.
And the move in yields doesn't make you want to like the financials maybe a little bit more. I mean, it's, look, you can be a little tactical too. I'm not talking about, 12 to 18 month trades necessarily, but or investments, whatever. I'm thinking of things that are going to continue to work well. For example, if yields continue to remain elevated. I mean, financials have been on this for like 10 or 11 weeks in a row. It's the longest streak ever. And not by accident.
Yeah, you've got a nice bounce off the low from the alts. You saw with KKR. The insurers have lagged. I mean, some things have lagged, but Yeah, sure. If I'm trading, I probably buy some regional banks for a little bit of a trade. Usually they can, capture some net interest margin when that happens. But in the medium or long term, I still think you want a healthy amount of AI revenue exposure, and the transition that'll happen in the S&P is that transitions to AI productivity exposure. And so I like healthcare and other stuff that will be primary beneficiaries of that. So
If you're not worried that much about rates and you still think that the economy's pretty good.
Yeah.
And you, by the way, you've come around a bit on your view on the consumer and some of the discretionary related names.
Yeah.
Which you were pretty dour on in the past. But
yeah, we had a really good call to be underweight for a long time.
Yeah.
We went to market weight right as I thought some of the hormone stuff was starting to settle in a little bit and looked like you'd get a little bit. And to be honest, I think this whole K-shaped economy thing, people have pumped the brakes on because it's really not an income statement thing. It's hard to have a big problem when unemployment's this low. It's a balance sheet thing. So people aren't getting rich on the balance sheet in the lower end of the consumer the way rich people are, but they have jobs if they want them and wages are okay. And so when you look at things like 90-day credit card delinquencies, they're actually low and declining from a year ago. You're not seeing the kind of financial stress that you would normally see in what people think is late cycle. And that keeps me somewhat optimistic that the consumer will hold up in the fourth quarter.
then doesn't that mean that you should change your portfolio a little bit? I mean, if you came in there and you were thinking, I want to be overexposed or overweight to tech.
Yeah.
But now I've had a market broadening. And then I hear, Adam Parker is kind of talking pretty positive about the consumer and maybe the K-shaped economy or the so-called is over. And we just have a pretty decent economy and the general consumer is doing pretty well.
Yeah.
Top's doing better, but still everybody seems to be doing okay.
Yeah.
Employment is what it is. What are we at 4.1 on the unemployment
Yeah,
rate?
it's low. Yeah, so I think you can buy there's tons of stuff to buy, but I think ultimately when we started the top of the hour with NVIDIA and Micron, I think they're going higher and meaningfully higher over the next 1, 2, 3 years, because the way I'm thinking about the world is AI started in May of 2023 with NVIDIA's first upward sales revision. 3 years, 3 months ago, okay? And it's an 8 to 12 year spending cycle. We're not even halfway done with what's going to happen in the spending there. And so the total amount of cash flows and earnings that are going to accrue to compute is just going to be massive.
Oh, wow. So then you think the bull market's got a really long runway?
I do, yeah. I mean, I think 28, 29 earnings could be very big, and I don't think it's all in the price yet. So that's the North Star that we've been talking about for years, about semis being the North Star.
Yeah.
And you got to hedge it, because when you get diversified, when you get big pullbacks, it's sharp, and you see businesses that there really isn't a growth scare, and all of a sudden Nebius isn't half for no reason or whatever. You can get pullbacks that are meaningful, so you have to diversify. Maybe you buy some diversified consumer, maybe you buy healthcare services, maybe you buy oil stocks because the price is up. I mean, you got to have a portfolio, but the North Star is still semis winning.
Okay. Yeah. You hang out. We'll come back to you in a little bit. I do want to talk about mortgage rates. If you want to see where the impact of rising yields is having maybe the greatest impact, it is mortgage rates. Diana Olick's been tracking this, of course, and the numbers you had today were not pretty.
No, they were not, Scott. The average rate on the 30-year fixed mortgage inched up again to 6.75% this morning. That's according to Mortgage News Daily. And, rates have been hovering around the higher end, highest levels in over a year, in fact. And that's hitting affordability again. We got the numbers on pending home sales this morning, and they were well below expectations. These are based on signed contracts on existing homes, and the realtors noted higher mortgage rates specifically. Now, we also got July single-family housing starts, and that was an even bigger drop, down 10% from June and down 16% year over year. Now, stocks of the builders, we're not loving that. The builder ETF, ITB, that one's in the red so far today. We do get quarterly earnings later today from luxury builder Toll Brothers. Toll has been performing better than its peers because, of course, it's on the high end, and the high end is doing better. Now, in the report on builder sentiment yesterday, the NAHB noted that custom builders, again, we're on the high end, we're also doing much better than the production builders. So, again, it's about higher rates and affordability, Scott.
All right, Diana. Thank you, Diana Olick, Home Depot CFO, declaring the housing market today, quote, frozen, in part because of rising rates. High mortgage rates. Pippa Stevens has more. Hi there.
That's right, Scott. So as rates stay stubbornly high, Home Depot is saying housing turnover is at historical lows, and that it's never been lower as a percentage of the housing stock, adding they don't see any type of inflection point at this moment. That means that larger discretionary projects remain under pressure. The consumers are turning to smaller repair and maintenance projects, including painting. Now, overall, the company topped estimates, posting its strongest same-store sales growth in almost 4 years, and said $730 million in tariff refunds helped to partially offset higher costs related to fuel, energy, and other product inputs that weren't in the company's plan at the start of the year. But the stock's not doing much today after Home Depot did not raise guidance for the second straight quarter, despite revenue beating expectations by nearly $1 billion in the fiscal first half. The decision to stick with guidance, first issued back in December, seemingly pointing to the company entering the back half of the year with a note of caution. Scott?
Pippa, thank you. Pippa Stevens, the moving yield certainly makes next week's Jackson Hole speech by Fed Chair Warsh all the more interesting. CNBC's Matt Peterson joins us now. It's good to have you on the program again. I mean, how do you think this backup in yields is playing inside the Federal Reserve, and how might it impact those comments next week?
That is exactly the right question. I wish I knew the answer, but Kevin Warsh has left us all scratching our heads about exactly what he thinks about this rise in yields. This is one of the big confusing points that came out of the press conference he did in July, was that he sort of said he thought that it was good that, yields were rising on the long end. He's also, on the other hand, said that he's worried about the housing sector where he wouldn't want to see yields rising, right? So we're left to kind of figure out what exactly does Kevin Warsh think about the bond market, and that I think may be something that we learn a lot more about at Jackson Hole.
I mean, he wants the market to, sort of figure it out, if you will, on its own. Is this proof of be careful what you wish for?
Yeah, I think that's exactly what this is, right? You're seeing the long end now accommodate all of this uncertainty about exactly where the Federal Reserve lives. It's not reacting to the ball, as I said. It's playing the umpire. Kevin Warsh, wants to get this sort of undiluted market signal, but it's really not clear that we're ever going to get one. There's been this concern about a sort of hall of mirrors thing that he now seems to be trapped in. Again, he's got a chance to explain himself, and we'll see if he avails himself of that.
I mean, if he takes a more neutral stance, so to speak, out in Jackson Hole, what do you think that would do to interest rates? Could that take them off the boil a little bit so he can accomplish a lot by saying even just a little?
It's possible. I mean, I'm sure he would hope to achieve that. But I think the question now is whether interest rates are just going to keep moving regardless of what the Fed says here, right? The Fed actually needs to act in order for people to believe that it's going to step in when inflation is rising. I mean, inflation picture is mixed, so it's not, an obvious call one direction or another. But that was the upshot of this confused meeting, was that folks just don't really know how the Fed is going to react.
I mean, he does sort of get the benefit, if you want to use that word, from the fact that some of the economic data of late was on the weaker side. So the market now less expects a move in September. So I'm not sure exactly what that leaves him thinking he needs to say in what is typically a pretty consequential speech. I mean, I remember thinking back to Chair Powell right before the Fed started raising rates. It was 8 minutes of pain. Remember, it was just an 8-minute speech, but it didn't need to be anymore.
That's right. I mean, the Fed chair can move markets pretty far with just saying a little, and there will be a lot of attention to this speech. That's it. He could take this opportunity just to give us his sort of grand vision of how regime change works, right? How would markets react to that if we didn't actually get a really close read of the economy? We might see yields continue to rise at the long end because people continue to say, well, we just don't know how the Fed is going to react, right? He's got a lot of different ways that he can play this. I think the safest way is to go in and do a kind of Jerome Powell reading of what the economy is looking like to Kevin Warsh. But he's really resisted doing that at every chance that he's had so far. And it's hard to see him breaking with that pattern.
See what happens. We'll probably talk to you again too, Matt. Thanks. Appreciate that very much, Matt Peterson. Let's welcome in our panel, Schwab's Kevin Gordon, Neuberger's Shannon Sakosha. Of course, Adam Parker is still with us. Kev, it's good to have you here. So you tell me what you think about the market, the reaction to yields rising, if you think that there's a cause and effect, that the market actually is reacting to what we're watching in the bond market.
I mean, it's hard to say because you still have breadth that's net positive today for the S&P. So outside of tech and a lot of the weakness associated with the mega caps, there's not that much of a negative market story. The whole discussion around yields, it's interesting because this is so much more focused and centered around the level and not the rate of change. typically when you have a spike in yields and it's aggressive over a shorter time frame, that's when you get these bigger ruptures in the market. That's when you sort of raise the correction risk. But that's not really what we're seeing right now.
I mean, frankly, I'll be honest with you, I am referring to the move, not necessarily the level. The level just says, well, it's the highest. Yes, exactly. That doesn't mean anything. If I tell you that as I sat here while Chair Bush was giving his news conference, at the most recent meeting, we were below 520 in the 30-year, and we watched it tick above that level as he spoke, and then it's just continued to move higher, albeit 10, 11, 12 basis points since.
Yes, and I think, but from here you would need sort of an extended move. So I'm sort of backing this out, 2 to 3 months. If you continue to see it and you were on the pace that you had in the reaction to Warsh's press conference, that's when you would raise the bar more or you would raise the risk more for corrective activity. So still, even from that point, it's not that aggressive relative to history. I don't want to dismiss the move since then because you've had sort of this, what I've been calling a twist tantrum where the long end has been rising, the short end has been falling. That clearly has been the market, losing a little bit of that outright confidence in Fed's going to do, but just maybe questioning more around the inflation fighting credibility, side of their mandate.
Shan, Mark Newton of Fundstrat, he's the technician there who works with Tom Lee, was out with a note today suggesting that it was just a matter of time before the equity market was going to start paying attention to the backup in yields, and maybe this is the moment.
Yeah, well, this is typically when the equity market starts to look around is at the end of earnings season. PEs have been compressing already, Scott, over the past 6 weeks or so. And now what you're seeing is that you don't have that stronger earnings growth to fill the void and distract from these yields. The other challenge here is that we're talking about the strength of the AI build out. And that's what's driven these extraordinary earnings numbers over the course of the last several weeks. When you look at the debt that is being issued, not only kind of above the line and, in the public market, but also in the private market. And you think about the potential for that to be cannibalizing demand for treasuries. All of that compounds some of the fiscal concerns and the sustainability and reminds everyone that while we have so much enthusiasm around the earnings growth, we still need to finance a significant amount of CapEx. And that is going to be competitive to Treasury. So I think there's just a lot happening, not only here in the U.S., you pointed this out yesterday, globally, we're also seeing the long end of the curve rise. And I think that there are questions on fiscal sustainability, but also there's just a lot of additional credit and debt being issued. Who's going to fund that? And where is that capital going to come from?
Yeah, well, there's paper flying all over the place. So I'll ask the same question I want everybody's answer. Kevin Gordon, I'll start with you. Is it true that as long as earnings remain as strong as they are, as long as AI spending remains as robust as it is, and as long as the Fed doesn't do anything for a while, then the market's just going to continue to go up? Is that a fair?
Oh yeah, I think the runway is certainly, it's not completely smooth, but I think.
Sure, but just moving rates is noise. More noise than anything.
Yeah, I mean, well, and I think here's the difficulty in talking about sort of this whole backdrop with yields where they're at right now. Clearly, you have parts of the economy that continue to struggle. Diana was just laying out all of the issues with housing. You clearly have some parts of the consumer that do struggle under higher interest rates. The problem is that doesn't really necessarily show up, if at all, in S&P 500 earnings, and that's what the market is ultimately going to key off of. Plus, you have an environment where nominal GDP growth is 6.5% year over year. That in and of itself is suggestive of Treasury yields sort of continuing to drift higher when you have that robust of economic growth, but you also have stickier inflation. You put that together with the geopolitical risk premium that's clearly rising, and you have that sort of pulling and acting as that force, sort of anti-gravity force for yields and moving higher. So I do think that the runway for the S&P 500 in that scenario is relatively fine. But again, not without risk if you go through these sort of catalyst moments.
Trump is considering a tariff reprieve
in this environment of a negative correlation between
on Canada. Okay, Trump is considering granting Canada a tariff reprieve.
It's the same kind of question I guess we could ask about rising oil prices, Shan, right? I mean, the market was able to, shrug that off, so to speak, just because the earnings stories.
Microsoft rising.
Story is too compelling. And by the way, if you get eventually some sort of resolution with Iran and oil does actually go back to 70 or below, then you would figure that yields would come down as well. So the market was able to look past the oil, Iran war story for the most part. And maybe it's going to do the same with rising yields for all the reasons that we just said.
Well, I think that has more to do in terms of the lack of clear transmission to other parts of the economy, though, Scott. I mean, aside from airline fares, 25% on a year-over-year basis, we really haven't seen that energy price pass through, except really in refined products. I do think that what the market is looking through, though, is exactly what Kevin noted in terms of just the breadth of the earnings growth that we have ahead of us. And the reality that if you're looking to invest capital over the next 6 months, the alternative to U.S. equities would probably be equities elsewhere, just given the robust earnings growth that's being generated in ex-U.S. in small caps. So, whenever you look for an alternative to U.S. stocks in this market, even if you want to dilute some of your AI exposure, there's a lot of other areas that are also exhibiting strong earnings growth and don't have this long end duration concern that you potentially have to grapple with if you are trying to play the long end of the curve.
I'll give you the last word to sum it up.
Yeah, I think your oil analogy is perfect for rates. It's self-correcting, right? When oil gets too high, then demand slows and it corrects. It's the same thing with rates. Like if you get a growth scare, then the yields will come back lower. But so it'll be cyclical, but the train is still headed in the same direction. The way I'd pitch it to you is earnings are going to grow probably 40, 50% over the next 3 years, some number like that. The market's not going to be 40 or 50% cheaper in 3 years. It'll be 20% cheaper or something, and the market will be up materially when you do that math.
All right, we'll leave it there. Thanks, everybody. Appreciate it very much. All right, we're just getting started here. Coming up next, Meta on trial. The company facing explosive claims. It designed its platforms to hook kids, putting profits ahead of safety. We've got the very latest on a landmark case underway as we speak. We're live at the New York Stock Exchange. We're watching Closing Bell on CNBC.
All right. We have about 36 minutes to go. 36 minutes. Apple starting to bounce up. Trying to stay above the 50-day. Apple would be nice. Google turning back up. Google. All right, NVIDIA, a little short covering. Still sitting here at the low. It's about $1 off the high. This is deceiving. This is 220 up here. This is 219. If you need hedges, I would consider butterflies by the end of the month, August 28th. The end of the month is actually the 31st, but I'd rather buy a Friday. So the 28th of August, buy maybe 765, 760, 755 put flies, pretty cheap. Or 760, 750, 740. Or 750, 760, 755, 750. Those are pretty cheap too. And if we do get a move lower tomorrow or the next few days, if we get a move lower and VIX moves higher, okay, that combination of VIX moving higher and S&P moving lower will shoot those put flies value much higher. Something to consider if you need it. If you don't need it, just hold on to cash.
Temporarily, because it is a setup that could be repeated.
I think it's more so you can use volatility as a tool to express your opinion. For a long period of time, frankly, since kind of like mid-February, volatility is incredibly elevated. So if you were using options to execute a directional view, even if you're right, you're probably wrong. So it's just too darn expensive. Now things are at the point where they're fair to possibly even cheap. So you can utilize the tool in your toolkit to express whatever your view happens to be.
Zed, always great to have you in. Appreciate you putting on your educator hat
for us today. I always love when I have expertise in studio with me. We can break down some of these more complicated topics. Such a pleasure to have you. And that's Seth Francis, the CIO and co-founder of Investment. And I will send it back over to Sam in New York with a look at what we got coming up.
S&P coming back off the low, headed back towards VWAP, a doji pattern on the daily, doji pattern. Okay, let's see what up-down volume looks like going into the end of the day.
Opportunity don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, read upnetwork.com.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Market on Close. I'm Marley Caden alongside Sam Vadas in New York. Carvana is falling today amid concerns that its largest shareholder, Mark Walter, may sell his stake. Walter, the CEO of Guggenheim, has reportedly been under federal investigation and recently sold his controlling stake at the Los Angeles Lakers, while reports have arisen that he is in talks to sell his stake in the English soccer team Chelsea. Walter held 30 million shares of Carvana, equal to about 4% of outstanding stock as of June 30th. That's according to data from Bloomberg. I do want to turn our attention to the Chinese economy, though, bring Sam back into the conversation, and also our in-studio guest, who also happens to be named Sam Radwan, the president and CEO of Enhance International. Sam, great to have you back with us. A pleasure to have you here in studio. Now, China just reported what you describe as the largest contraction in consumer and business credit in 20 years. How significant is that for the health of the Chinese economy?
Very significant. And let me put it into numbers, right? So you have the largest contraction in credit in the past 20 years, right? Maybe under 40.
The most consequential case on this issue to date.
Well, Scott, before I need to preface my comments that I'm a big believer in AI. I think it's going to make the world a much better place longer term. But I think what we're seeing here around the courts is minimal. I think it is the tip of the iceberg of what is going to be a sea change in terms of the influence that these platforms are going to have on teens and how they see the world. And so there's kind of two different lenses to look through. You know, the setup that Julia did right there, you know, the impact on Meta. Let's say ultimately they're probably going to pay somewhere around 25 billion in fines over the next 5 years, just rough numbers. When they're at a steady state of cash flow, they're going to be generating after they get through this CapEx burst here, probably 40, 50, 60 billion a year. So they could definitely afford 5 billion a year in losses. But that's not the point. The point is that Zuckerberg in his manifesto back on August 10th basically said they're throwing out the old playbook, the playbook being the Instagram playbook, where you get things kind of fed to you, and they're moving to a superbot playbook based on super intelligence. This playbook is going to be agent-based. Zuck said on the call that they want easy-to-use agents for billions of people. And he talked about this fundamentally changing their revenue models. And so why that's so important relative to this conversation is the potency
of what is going to come down the pipe from Meta around agents and the influence that they're going to have on people under 18 is going to increase exponentially. And my sense is this is going to probably move at first at the speed of a glacier and then a fast glacier. But what Meta's going to be set up for in 5 years from now is probably lawsuits that are dramatically bigger, because if Zuck makes good on talking about or fulfilling this promise of super bots, what we're seeing right now today is really chump change.
Is there any legitimate algorithm risk here, do you see? Because to me, that's sort of the holy grail of the whole conversation. The money's the money, as you suggest, you know, and the kind of numbers that you were talking about, it's reasonably inconsequential to the company's overall business. But the change in algorithm would have a dramatic impact.
It would, and that would matter. So yes, there's algorithmic risk here that the legislation at the federal level is really talking about changes how these bots work. But if you take the approach that there's basically a renaissance going on with how they're doing their business, and I'm going to read the quote that Zuck had on the call. It says that the foundation of our next wave of products and revenue lines will change fundamentally in the months and years to come. And so as far as the algorithm, like in some ways, he's going to throw it out in the next 2 or 3 years. They are fundamentally moving to an agent-based world. Now, the agent is going to have some look and feel to it relative to Instagram. All the things you love about Instagram will be there. But this agent piece of it, I think, is going to be something that he believes there are large revenue lines. And so any sort of change to the algorithm really needs to be put in context to whatever their revenue model is going forward. And I think that's going to be squarely built on the back of super agents.
I mentioned you don't own the stock, nor does Deepwater. But what do you like most right now? Which company do you like the most of the hyperscalers?
I'd say maybe of the mega caps, if you kind of take this conversation and say that, yes, there's some truth about how AI is going to impact personal and agents are going to be a bigger impact of our world. If you believe that's true, which I do, probably one of the biggest underappreciated companies is Apple. And then in their case, you know, they're not going to have that same risk related to what's going on here from the machine. Apple's going to take a more conservative approach in terms of how they build rails around this. But what we're seeing in Siri right now with the beta, what I've been testing for the better part of the past month, is they finally got it right. I mean, I think that this is something that right now, based on our research, it's shockingly less than 20% of iPhone owners in the U.S. use Siri on a daily basis. That is
I don't use Siri at all.
Personalized AI part of this conversation. And Scott, I think that the shares get re-rated. The earnings might go up a little bit, but I think the multiple is going to go up measurably next year.
Wow. I mean, so in an environment where, you know, AI was viewed as this company's pain, now, ironically, see its gain. Interesting. Yep. Gene, we'll talk more. Thanks, Gene Munster.
Thank you.
Yep, still ahead. Full court drama, the family feud playing out over the future of the Los Angeles Lakers, what it means for one of sports' most valuable franchises and others. Following the money next.
All the chips got whacked today. Looking for those to catch a bid. I don't know if it's going to happen this week, but yesterday everything looked good and then it faded immediately. Let's see, NVIDIA. Netflix.
ChatGPT Teams version chatbot with safeguards for users 13 to 17. Yeah, now, but all right, let's just start here. What depth of chat GPT for teams now is different from millions of people? It's basically the kind of response that OpenAI is having towards kind of questions around safety when it comes to, these chatbots or AI apps and teams. There's been various reports about people claiming that they've led to relationships between AI and teams where, they people become delusional over time. The teams have gone on to self harm. That the chatbots have given them kind of steps on how to do that, or encourage them in certain instances.
Especially in biopharma space, what would need to happen for China to fully make that leap?
It's like let me give you the statistics though. The statistics are very, straightforward, right?
Netflix pulling all the way back from the high.
Trials conducted in China were 3% of the market. Now they're around 30%. The US is at 33%. So they're there with the US, right? Promising drugs, right? Have basically grown 500 times since 2015, and now they're neck to the U.S. So they're there. People keep talking about when is China going to catch up with the U.S. China's already
Netflix fading right back to VWAP.
So now it's a question of, can they own the entire value chain? Can they show that they can distribute in Europe and the U.S., right? And that's where they're going to take the leading position, right? So that's why I used the example of Beijing, right? They've shown that they can do it, right? So it's just a question of how many more of these companies are you going to see moving forward.
It's not a matter of decades, it's a matter of years. Sam, really appreciate it. Thank you so much for joining us in the Chicago studio today. As always, appreciate your thoughts, Sam.
All right.
We will discuss the unique investment opportunities that Pilot provides for US businesses that are around the world today. That's coming up next.
Same goes for where you invest. Level up and invest smart with Schwab.
Have you ever watched an interview and thought, I understand why
we really look forward to welcoming and engaging with companies when they're at that early stage of discussion.
And I want to highlight exactly how many people and companies are taking this bridge to Europe here. We have more than 1,000 U.S. operations now employing more than 218,000 people in Ireland. What does that tell you about the depth of the economic relationship between the U.S. and Ireland?
Yeah, I think it's a partnership. And when we look at some companies from the Chicago area, the likes of Abbott celebrated 80 years in Ireland this year. So that's the test of time in terms of the longevity of the relationships. And what we would see, companies in our life sciences, biopharma, medtech, technology, they're companies that in many cases have been in Ireland for decades, and they're reinvesting in Ireland.
All right, we're coming into the closing bell.
Been a success so far, and they're reinvesting in Ireland, I think, because of the stability that Ireland brings, because it's a stable economic environment. It's one where there's a high degree of comfort for companies that invest here, that it's low risk, and it's also such a long track record and partnership with companies doing business from specifically even the Chicago area in Ireland. They can be very comfortable with the decision they're making to invest in Ireland.
And one area a lot of companies are having instability right now is tied to tariffs. They've been forced to rethink supply chains, where they're manufacturing certain products, where they're getting products from. Are you seeing companies delaying investment decisions because of uncertainty still tied to tariffs? Are they actually changing locations of their operations?
I think what we're seeing in the early stages of tariffs, I think there was certainly a watch and wait approach from a lot of our clients where decisions may have taken
Netflix about $1 off the high now, or a little bit more than that. 70. We hit 79. We're down to 77, 78.
Innovation and that resilience, particularly in things like supply chain that you mentioned. So Ireland being that safe pair of hands, for want of better words. So companies very happy to choose a location like Ireland, particularly when globally things are probably more dynamic than they have been for a while.
And I saw in some of the data and information that you sent over in advance that companies are taking these more strategic positions. They're locating operations not just here in the U.S., but also in Europe, rather than concentrating everything in one location. There is a natural question here, though. If an American company moves its manufacturing or its R&D or its operations to Ireland, does that come at the expense of U.S. jobs and investment?
I think quite the opposite. I think what we see a lot of companies doing is the growth in Europe is to support companies' growth overall. So it's really a win-win. So companies that are doing really well in Ireland are actually companies that support the Chicago area. I think as well, one thing that a lot of people may not be as aware of is while there's a very significant number of US companies investing in Ireland, there's a huge amount of Irish companies with very significant employment as well in the US. So it's very much a partnership. The partnership is really made by win-win for both sides. So we're very glad to see so many Irish companies being successful here and also hiring a lot of people as well.
And let's talk about the inverse of that relationship too, because it is a two-way investment relationship. I have some of the facts that you sent over here. 800 Irish companies employing more than 200,000 people here in the U.S. The value there roughly $390 billion. So how important is
Apple turning back up.
the relationship to what you do and trying to
Apple cruising back up.
Yeah, I think a lot of people forget how small Ireland is. We're just a country.
Very whippy price action. Apple running back up now.
But then from that, we're seeing really amazing Irish companies grow, internationalize, and do really well in the US and also in other overseas markets. So it's really a rising tide that's kind of lifting all boats across the Irish economy, but also having a really positive impact here in the US as well.
And we're obviously in the middle of this massive AI investment cycle. I don't know that I can get through an interview without saying AI at this point. What role do you see Ireland in companies as they expand their operations internationally?
My first mention of AI is, yeah, I mean, we've seen Microsoft in our 1980s. Tech isn't new for Ireland, but I think as we look at something like AI, what we're seeing is, those kind of pure play companies that didn't exist not that long ago, like Anthropic and OpenAI, establishing their European headquarters in Ireland.
All right, Apple's on its way back up. Apple on its way back up.
I think companies like Microsoft as well. So it's permeating across the tech sector where we're seeing private being created, being driven by talent, being driven by innovation. So
Apple headed back up.
In a sector that's changing and growing so quickly, Lauren's working really hard to make sure that talent is available from an education perspective, from a training perspective. And we're seeing AI now across our life sciences sector, really going across all sectors in roles that we would never have seen technology per se in creating employment in Ireland. And when we first started talking, you highlighted some of the reasons why Ireland, why these companies are choosing Ireland, but historically you've also been known for your corporate tax rate. So how much does that come into play here as well? Yeah, I mean, I think tax is part of the overall package. There's certainly places where tax rates are lower than Ireland, but when we look at where we are in terms of tax as part of our overall package, it's just one of a number of factors that companies will assess. And I think when they look at tax, but they also look at the talent, they look at the track record, and look at their peers who may already be in Ireland or who are expanding already in Ireland. I think that's where the overall benefit of Ireland comes.
Apple back up. Trying to stay above the 50-day. Snowflake trying to turn up end of day. Got about 11 minutes, 30 seconds to go.
PSSA may resume in less than a minute.
It's why you know you're in this place. No balls. Fantastic. Shine some names. Everything in one place. It's like Schwab. Everything investors need comes from a place. At Schwab, they can do everything. Invest, trade, give full service fund management. Sick. They have to buy. Invest your money with Schwab.
Welcome back to Market on Finance. I'm Sam Bunnan. It's live from the floor of the New York Stock Exchange. It's time now for portfolio of stocks, furniture company, Flex Steel, for sale.
PSSA may resume in 10 seconds.
Jeff, good afternoon. We say for Flex Steel, a nice 16% gain right now. What does it do, and what can we learn from these earnings?
Really great question. This is a company that a lot of people they've come across that they didn't hear of until today. They're based out of Dubuque, Iowa. They've actually been around since 1893, if you can believe that. They have about 1,400 employees, and they're one of the largest U.S. manufacturers of quarters and acres of residential upholstery furniture. Big sofas, recliners, sectionals, and so forth. So through independent dealers, e-commerce, and some company-branded retail. Now, if you've set a recliner for the lifetime of a spray-based warranty and never sat in some suites of beers, that's their blue steel spring. A shout out to you Zoolander fans out there today. That is why they're up about 16% today, Sam. And they're up about 103% so far year to date.
Yeah, I
mean, it might be somewhat overlooked, but you could be sitting on it right now and not even know. Just wondering though, I think the game year to date. I mean, it looks like this chart of flying for what are the reasons behind this today story?
You're absolutely right, Tim. Seeing when we're looking at this, is this small cap company, because of their availability, as well as I think getting ahead of the Sierra situation, they were able to produce stronger results than some of their competitors. They Ethan Allen, Ashley's Furniture, maybe even IKEA as well. But because of that, they moved all of their manufacturing away from China. So they're no longer in that scrappy fight right now with the U.S. government. They did benefit from a tariff refund, so they have that on the books this quarter. But a lot of their manufacturing is now coming out of Vietnam as well as some from Mexico. So I think the big story here, Sam, is that market K-shaped recovery.
Apple's still pushing back up to the highs, doing what Apple does. Shake people out in both directions. Netflix dropped off. Not sure what happened there. Should be fine.
Dividend. They increased their dividend to 25 cents, 25% increase. Why is this so significant? They have now sent dividend for 338 consecutive quarters. They paid it through the Depression, through World War II, through multiple recessions, the 08 financial crisis. Even though they reduced it for a little bit, they also paid it during COVID. Something to keep our eyes on as we move.
The 1890s. I mean,
Everything closing off the highs of the day. Let's go see what New York Fang looks like towards the end of the day. Okay, that looks a little bit uglier than it did earlier. If we had a bounce, we did have buyers stepping up at the low of the day. Looks like we're headed back to the middle of the Bollinger Bands, at least the 20-day. New York Fang components.
And what could be an impetus if we aren't buying new homes to get new furniture.
Something to watch. Jeff, really appreciate the breakdown as always. Thank you so much for that, Jeff Avalos there. Marty, I'll send things back over to you in Chicago. Thanks so much for Sam and Jeff for that one. We are nearing the end of our market session. That means that's probably going to go to break down the trading day. And then after the close, we'll get earnings from Keysight Technologies. That's all next. Stay with us.
Opportunities don't stop when you leave the hands. So Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24 hours support from trading specialists who understand the ins and outs of 24-hour trading.
Microsoft back down to the lows of the afternoon session. Microsoft. Okay, we got 4 minutes to go. Let's see, Microsoft. Doji on Microsoft. All right, what's Cerebras doing? CBRS Cerebras. It did pull back today, Cerebras. Nike with a bounce. Nike minimal. Did we start to see some progress? It's still in a base down here at the lows for the last 4 months. Nike, no progress. CRM earlier, bouncing CRM. Less than 2 minutes to go. All right, we're coming into the closing bell. Got an hour and 1 minute, 30 seconds to go. Intel with some shorts covering. Intel end of day. Still sitting on the 21-day Intel. Shorts covering here. Okay, it was a dollar move there off of that low up to that high just now.
Right now in the NDX, 29,500 is sort of our middle line pivot point. We're slightly below that, but in the NDX, as volatile as that index is, we're certainly within the range to call that sort of that zone. So I would say we're in a pretty critical zone with the NASDAQ here. It's a slow motion crash in general, but if some of these AI trades, it's anything but slow motion. I did look at a few that are on my board. Some aren't even really truly pure play AI names. Caterpillar down over 4% today. Marvell down 8%.
All right, folks, that's the closing bell.
Really just tremendous volatility in some of these names. Guys that, if you're invested in that, it certainly feels like a crash, but it's almost an upward.
So Target, we have earnings tomorrow morning. I was thinking about a trade, but then declined. Target trending. Anyway, we'll be looking at some opening range trades again tomorrow. The morning was good, especially with Apple. Have a good evening, everyone. Take care. I'm your host, Cousin Benny, coming to you from theclosingprint.com. It's Tuesday, August the 18th. Have a great evening. Take care, and we'll see you in the morning. Ciao.